the real growth picture is pretty poor everywhere.
From an economic perspective, I think all of us expect a deceleration, a slower economy.
This is the environment where you have to be more nimble.
We're cautious and think that the conditions are there for a full-blown recession.
I think we're going to get a lot of clarity this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market on the S&P 500 positive by 0.1% after the close. A little bit later, earnings from Microsoft and Google and TK. A little bit later this morning down in Washington, D.C., that two-day meeting begins for Chairman Powell and co.
It begins. I wonder if they're going to pay attention to earnings. They're going to pay attention to something. And I'm going to say, John, they're going to be sobered. What you pointed out yesterday out front with the ECB being more important, that the quality, the character of this German recession is something that's got to be in the back of the mind of a Fed meeting with some uplift, some optimism to the American economy.
German business confidence, terrible. There's a clear split worldwide right now. We're talking about the Fed trying to engineer a soft landing. China trying to deliver some stimulus. And Europe, Germany in recession. We had corporate loan demand from the bank lending survey for the ECB a little bit earlier this morning. Demand for loans from corporates dropped the most on record. Does that sound like a tidy, nicely functioning European economy right now?
No, it doesn't. And the overlay to me, and I don't know where it's going to end up 5-10 years from now, as we have, as Olivier Blanchard mentions, the Biden stimulus, or a set of stimuli. Is that the plural? It's like,
We'll go with that.
I'm going with the Latin today after X yesterday and all that. My bow tie's in the shape of an X today in support of Mr. Musk. But, I look, John, at the austerity mesh across Europe, and it's catching up with them. Where's the stimulus? I mean, if you're going to have a slowdown like that, there's got to be a culture and a character to a stimulus. I don't see that. That will be a topic in this two-day Fed meeting.
Europe needs a favour from China. The euro's negative for 6 consecutive sessions. That's euro dollar down, weaker. Tom, we're down to about 110.40 at the moment.
Quietly, Brent crude 82.60. I'm watching very carefully this tug and war of global demand, where there's some real question about the lift over the next 2-3 years, and yet oil's like this, and a number of analysts have come out. Jeff Curry came out with Goldman Sachs and really reconfirmed there has to be a demand lift at some point.
After the close later, away from commodities, it's going to be about whether we can validate just massive gains year to date. Take a look at these names. Google, Alphabet, whatever you want to call it, Microsoft. Microsoft's up this year by 44%. Alphabet is up this year by 38%. Can they validate those massive gains after the close later?
I think within the media, Microsoft is underplayed. It's not cool. It's not the cool stock where Google's still got some of that cachet left over. I'm looking at Microsoft with a 35 PE, a 10% 5-year dividend growth. The yield really doesn't matter. On the edge of the cusp of $3 trillion, $2.5 trillion. But I'm going to watch Microsoft very, very carefully. There's some concern, John, about what they're spending on a presumed AI attack. There, we got it in. First quote of AI today. It's the new surveillance drinking game. When we mention AI, I have a sip of Tang.
Hey, if you want a drinking game later, the earnings call for both of them, for Alphabet, for Microsoft. Just tally up how many times each of them say AI on that call.
I thought of this yesterday over a beverage of my choice. And, Tim Cook, does he put out a mandate that no one at Apple can say AI during the calls?
I imagine he's going to talk about AI.
I'm fascinated
That would be
how
my
they
guess.
position themselves versus the others.
We've got time to do this, so let's do this. Compare and contrast two quotes. Going to use one quote from Marko Kolanovic over at JP Morgan and then compare it to another quote from Mike Wilson of Morgan Stanley. Both of them have had their calls challenged by the market action of the year so far. Let's start with Mike Wilson, who said this, Tom. We were wrong. 2023 has been a story of higher valuations than we expected amid falling inflation and cost cutting. Still pessimistic, by the way. Compare we were wrong to this. Marko Kolanovic at JP Morgan. We acknowledge that we cannot time this inflection near term, but there are no data points that would prompt us to change our methodology or conclusions.
I got huge sympathy here because I've been wrong big time with people's real money. And I thought it was misreported. This I got to be careful here. It was not misreported. They just didn't put up top, particularly of the Mike Wilson call, that he really didn't change his parameters, his guesstimates for 2003 or mid-2024. I believe it's 4,200 for the middle of next year. He said we're wrong, but he didn't change anything.
Still pessimistic.
And for pros, that is, you nailed it. A lot of other people didn't nail it. It's one thing to come out and say you're wrong, but if you're wrong and change your call, that's a different story. For example, at BNP Paribas, Greg Bottle came out right now and said, I was wrong, and BNP lifts their estimates. That's real news to me. I didn't see that with Mike. He didn't change anything yesterday.
It certainly didn't see that from Marco over at JP Morgan either, did we?
Well, that's a different
certainly
story.
Didn't even hear we were wrong.
Yeah, the Marco thing I don't follow as closely as you do, but I would say, folks, it's real simple. The strategists, including Eric Friedman, rumor is they put their pants on one leg at a time. I mean, Friedman walks on water, but the bottom line, John.
The human beings.
This is a tough business. Is the reality.
Agreed. Let's turn to the price action just briefly on the S&P 500. Equity futures shaping up as follows. Futures look like this, positive by 0.4%. Just a moment ago, some numbers from GM, believe it or not, Tom, released on a Chinese website, in Chinese on the website. So I wonder if this was
breaking embargo.
I wonder if this was an accident. So the release is in Chinese on the website. The range for full year net income looks like this: 9.3 billion to 10.7 billion. They had seen 8.4 to 9.9. The estimate was 9.4. So a range of numbers there.
Yeah, to explain this very quickly here, we've got precious time right now, folks. Many earnings are embargoed where we see them, but we can't report them, and sometimes somebody gets out front of that embargo. And the Bloomberg headline says release in Chinese on website, sort of cuts to the chase as well. Data, what do you see? I'm watching Euro Swissy. I'm sorry, I got stronger Swissy.
Stronger Swissy, is that what you're focused on this morning after looking at those GM numbers?
Well, yeah.
Is this like market roulette?
No, the GM numbers are great. I'm just on the data check. I'm looking, you look at the launch pad on the data, equities, bonds, currencies, commodities. The one number I'm looking at is Euro Swissy, says life goes on.
All right, let's get to Eric Friedman, shall we? CIO at US Bank Asset Management Group. Eric joins us now for a little bit more. Eric, catch-up trades. That's the focus of so many people coming into earnings season. Are you looking for the same thing?
We are, Jonathan. It's a matter of seeing if this market environment really fans out. And certainly people are focused on it by sector, but certainly market capitalization is probably the catch-up trade that's not catching as much attention as it should. So specifically domestic small caps, as well as domestic mid caps, but also in your backyard, Jonathan, of the UK, as well as continental Europe. So given the German data out this morning, giving that disparity, if you will, between services and manufacturing, it's really going to be a test to see if this market does buy into the idea of a soft landing and a gradual recovery. That would suggest that you need to get involved in some of those catch-up trades. We'd also include real estate, energy, and even utilities in that category of let's call it areas that have not been rewarded yet, but certainly could be should we see that soft landing materialize.
Eric Friedman, you and I studied Dow theory, up, down, and sideways. We read the Russell report years ago. John Farrell thinks it's a foreign and evil commodity. The answer is the Dow X number of days in a row lifts. What is the symbolism of the blue chip Dow Jones Industrial Average up, up, up each and every day?
I think the symbolism, Tom, is that in the face of deteriorating data, which is what we're seeing globally speaking, you mentioned Germany this morning. If you take a look at other PMIs around the world, if you look at the Chinese data this morning and the Politburo calling the recovery in China, quote unquote, tortuous, those are fairly emotive words for what is a gradually weakening economy. And yet markets are saying, give me a 5.25 Fed funds rate. We'll still buy equities here. So I think you're seeing a low expectation set across the marketplace for earnings, as well as for industrials, and that's being really bid up across markets, which again is counterintuitive relative to data, but we don't invest in data, we invest in markets.
In the growthiness of the moment, do you sell tech or do you hold it and just use cash in other sectors?
I think very hard to sell it here, Tom, and we're going to see some data points after the close today. What we're expecting from a tech capex standpoint is 3% growth globally speaking this year. But what's different is the mix shift, and what you're seeing is a migration away from on-premise to off-premise, specifically cloud computing, big data. Dare I use the acronym AI? Those are what's catching attention. So we're not anticipating a material lift higher in overall CapEx, but that mix shift, if you will, is certainly benefiting companies that you've seen. We think that momentum continues.
What's your blended mix shift of revenues? You've got unit dynamics. I'm going to assume they're flat to ebbing, but you've got a mystery in the price dynamic of revenues. What's your mix shift at the top line?
Yeah, I think the setup for this quarter, Tom, was a 3 to 4% decline in revenue and an 8 to 9% decline in profits for Q3. I'm sorry, Q2 earnings reported in Q3. We think it's probably too low. Inventory build has really been the factor. We've kind of gotten through, if you will, on the retail side, a lot of the supply chain issues. So I don't think it's so much the retail restocking, if you will. It's going to be the question about manufacturing. And again, that data point that we're seeing, that split between services PMIs and manufacturing PMIs, that's where the action is right now on the revenue side.
Eric, I want to go to John Farrow's good question that started this conversation. At U.S. Bank, you're dealing with this each and every day. Hundreds, thousands of relationships where people come in scared stiff because they've missed the post-pandemic rally. Maybe they've missed the rally since 2008, whatever. How do you catch up constructively?
Yeah, we think that the piecing in for those that are very gradual in their approach, Tom, is the right way to do it. And again, as a function of time, not necessarily as a function of price. We always get focused on price, and most investors who are scared about getting in worry about price. We think about things on more of a time basis. So again, if you have tuition payments coming up, that can be one variable you look at, just like a pension plan manages their liabilities. It can be very much the same with how a wealth client or a smaller institution that's not pension-based thinks about investing with a time bogey versus a price bogey. So that's really the best way to go about it from a psychological standpoint.
Eric, this was great. Thanks for responding to some of the news as well in the last 24 hours. Eric Friedman there of US Bank Asset Management Group. I want to turn back to those numbers from GM.
Yeah.
Just read them out a little bit clearer. Now I've got them in English and not in Chinese. Raising their full-year financial forecast.
You did well with the Mandarin.
Once again, terrible at Mandarin. The stock is up by 2.6%. So a raise to their full-year financial forecast. Mary Barra, the chairman and CEO of GM, in a letter to shareholders saying this: "We have worked with dealers and supplier partners to steadily advance our business strategy and achieve strong performance. At the same time, we continue to reduce costs and increase efficiency. We will focus on the most critical growth areas, such as electric vehicles, autonomous driving, and software to empower future business development." Mary Barra seems, Tom, saying all the right things this morning.
Saying all the right things. I go to Ite Macaulay at Citigroup. I was way out front on the General Motors distinction here versus Ford Motor. I'm not expert on it by any means, but they seem like they're getting it done. If I look at a total return, John, over 10 years, though, to me, the sector's a mystery. And in the last, speaking of X, I mean, I really don't know where the X auto company fits into this. I really don't understand 3 years out, 5 years out, what would be called product distinction that's made by the public. If you've got 10 EVs to pick from, which do you select? Total mystery to me.
And whether we're starting to see some pushback. You saw the price cuts of Ford. You saw the global inventory numbers that came out of Tesla in the last week.
Yeah, and the fancy people want EVs. I get that. I mean, the first EV I drove, frankly, was from the airport in Jackson Hole years and years ago, up to the lodge, and we've evolved from that to pretty much the same conversation: is do you want to drive an EV? Would you really rather drive a Buick? Well, the answer is, would you really rather drive an EV? And that's open to debate in America.
We'll catch up with the CFO in about 1 hour and 30 minutes from now. Looking forward to that conversation. In just a moment, we'll catch up with Anurag Rana of Bloomberg Intelligence on these earnings coming out a little bit later on this afternoon. Good. So after the close, numbers from Alphabet, TK, and numbers from Microsoft as well.
Guess what? A gift keeps on giving. I didn't know there was F1 this weekend.
Yeah, Spa,
Belgium.
Right? Belgium. Great race.
Is that a good race?
Oh, yeah, awesome.
Okay. It's great. I thought they could take a week break or whatever. They go right up there.
Then they get a nice long break after that, right? I think.
No, it's called like a European holiday.
You take August off.
They all get a holiday.
You have a nice long holiday.
Unlike me.
Futures on the S&P, just about positive from New York. Good morning.
I would argue that valuations are quite high. Certainly, I understand the tech sector and the AI story, but if we have a recession, profits go down, then it looks a bit rich right now for us. So we would be cautious, and we don't think it is immune to a recession.
That was Kathy Bosjanchit there, the chief economist at Nationwide Mutual, who apparently Tom got to talk about equities yesterday. You got Kathy to talk about stocks yesterday.
I think the linkage here is important. I did that on purpose. I think there's a lot of economic babble going on. There's a lot of market babble going on, and people think they're inextricably linked. And a lot of the smart people we talk to make very clear, well, maybe less than we think. And I think it's important right now to talk to equity people like Kalanovic and Wilson and the others about economics and vice versa.
Well, let's talk about markets right now. Equity futures just about positive on the S&P 500, rolling over in the last 15 minutes or so, but still just about in the green. And the bond market yields a little bit higher by a couple of basis points, 389.64. There's the weakness on the screen again on the euro. 6 consecutive days of euro weakness against the US dollar. That would be the longest streak going back to late September of last year. They were the parity days, sub-parity for the euro against the dollar. This time around, 110.44, but a string of euro weakness and a string of terrible data. PMIs yesterday, German business confidence today, demand for loans in Europe just dropping off a cliff. Now, maybe, yes, Tom, you can make the argument that's what the ECB wants to see, but it's happening pretty quickly.
I'm really glad you brought this up because I thought it was sort of spun around in an ambiguous way. People are saying, well, GDP's down, so loans are down. I don't think so. Loans are down because people don't want loans. I think, the microeconomics of loan dynamics in banking is a huge, huge deal. Loans are down because the appetite's not there, partly because of interest rates, but also just business oomph. It's just not there. It's, to me, a huge deal.
Different backdrop.
You see it in America.
Here in the United States. Well, we're talking about engineering a soft landing over here. Germany's in recession right now. A little bit later on, we'll talk about earnings from big tech. You get Alphabet and Microsoft, Tom, after the closing bell.
Yeah, right now we're going to get a brief on that. This is the most important conversation of the day for all of you enamored by AI. Anurag Rana is senior tech analyst for Bloomberg Intelligence. You can find him out on X as well. Great to have you here. You are just absolutely qualified to bring some clarity here on AI. Microsoft reports today, Google, they're all going to mention AI 44 times. When does AI become a value proposition? Now, down the road, or way down the road?
I think from a product point, perhaps sometime next year, but we are looking at the stock valuation, so already accounting for a lot of those revenue coming in. But from a usage point of view, the actual products, I think it's going to take 12 to 24 months.
Can you tell me about decelerating sales trends that we have seen develop in things like cloud? Are you expecting that to pick up again at places like Microsoft?
I think it's going to be either this quarter or next quarter. We're going to see the bottom in that particular growth rate, and largely a number of very hard comparisons from last year. Now we're coming to a point when the comparisons get easy, and some of the workloads from AI should start to help.
Well, this is what we're told repeatedly, that the AI boom is going to lead to incremental cloud spend, and I'm trying to work out how quickly we're going to see that come online. It's now too soon.
I think it's going to be sometime next year. So which means the bottoming out process, either takes by the end of the day today or perhaps, sometime in October, November. The reason is it's because currently predominantly the workloads are still the ones that companies are using to run their old operations. And over there, they are actually cutting back on tech spending. That's why we should see some pressure on cloud growth, at least in the near term.
So in NVIDIA, I have a countable set of chips that will benefit from AI. I've got a tangible thing I can count forward with NVIDIA. If I say I don't have that with Microsoft, if Microsoft's on the receiving end of the chips and then has to intellectually create with AI, what then do you look for in earnings today? Is there anything tangible to grab onto in this call?
So there are two forces over there, Tom. When you're looking at the greater push of workloads because of AI is one. That's a positive factor. But on the negative side, we are still saying corporate IT spending slowing down and pretty dramatically. Companies that have reported so far are showing less bookings, less growth in consulting, people not spending that much money. And that actually is a negative factor for cloud usage.
Well, get out front of Microsoft then today. Are you looking for a disappointment from Microsoft like these other companies?
I think it's going to be muted, but it's possible that the commentary on the call talks so much about workloads coming in that people will overlook that.
Ad sales. Let's finish there. What are we expecting from ad sales? we're having this big debate about whether this economy is slowing down, picking up, soft landing, hard landing. It's changed about 5 different times over the year so far. What have the companies said about what they've seen, the trajectory for sales through the year?
I think I've talked to Mandeep about this extensively. He covers Google, and I think they're looking for bottoming out again either in this quarter or next when it comes to that process as well. Only because it has been a tough year for them. But if you look at these big cyclical trends, sooner or later it has to bounce back. That's the nature of some of these businesses. It's a question of timing. That's pretty much our call at this.
I got 8 ways to go here. The success you had with calling Amazon off the bottom and all that. Forget about that. I'm fascinated with your encyclopedic knowledge, what you think of Twitter becoming X. I mean, to me, it's a bizarre thing, and there's a marketing thing and a social thing, and, John is on Threads and all that. But what does Anurag Rana think about X? How much destruction was that event?
So when it comes to consumer technology, it's very fickle. People move their habits very quickly, and we saw that with the success of Threads. I think they have lost a lot of the ad revenue. I don't think a lot of it comes back for them, only because people move on and try new things in consumer technology. It doesn't happen that much on enterprise tech. They stick around.
Matt Levitan asked the question in the last 24 hours, what did he buy Twitter for if it wasn't the brand? If it wasn't really the platform, could he have built it himself for $44 billion? What was the point of buying this?
I'm lost on it other than to talk to people like Matt Levine and Anurag Rana. I mean, it's so a jumble, John, and there's so much discourse out there from people, mumbo-jumboing like me, that I really want to listen to Anurag Rana or Matt Levine.
Anurag Rana of Bloomberg Intelligence. Thank you,
it's the only way
Anurag.
to go.
We'll hear way more from Anurag through the week when we get earnings from Alphabet and Microsoft after the close a little bit later. X, I still don't get it.
What is it?
I don't get
How
it.
do you pronounce XEET? That was out like 4
Is it like Zeet?
Zeet? That's what I was thinking.
Is it like that?
Yeah. I had one of the interns research it, and it's a Kurdistan word. It's a southern Turkey.
We actually using that word?
Iraq. I don't know. I don't
Okay.
know. I'll leave that. John Micklethwaite's in charge of those big decisions.
I'm just happy it's not a public company anymore, so we can just choose not to talk about it.
Which you and I do too much. We're told
quite
they're in
often.
our ears. Talk about Twitter. Talk about X. Talk about X. Ask
thank
Anurag
you.
Rana about X.
We said this yesterday. We want him to be successful. We want him to succeed.
Yes.
We're part of the platform. I think anyone who's part of the platform
steal from
wants
it
to
every
see
day.
it.
Yep.
Wants to see it do better. But right now, you still have these golden moments. Just awesome. Yesterday, the basketball player Giannis was joking about how he would take the offer from Saudi Arabia because he looks like Kylian Mbappe. And Mbappe just replied on the platform laughing. They are the kind of moments you only really get on Twitter.
Oh, yeah,
X.
and also for breaking news. I mean, we've used it so much, folks, to confirm speculation into real news. I mean, it's been a real tool for us. What's the Mbappe update? I mean, do we have any idea where he's going? I mean, I'm thinking Tottenham, but what's the...
You're hoping Tottenham. I'm doubting it's Tottenham. Massive offers coming from Saudi Arabia, north of $300 million. Huge personal offer as well.
That's just to the company,
I'm
just
sure
to the soccer
the club is engaging in those talks from what reports say, but I haven't heard that the player is in any way, shape or form.
Does he control the debate? I think for Americans, John, that's what's confusing here, going back to Kurt Flood and huge baseball legislation a lifetime ago.
He's certainly got some power.
Does he control his destiny?
He's certainly got some power. He's got a year left on his contract. It's going to be interesting to see how this works out. They don't want to lose him for free next year because he would be able to leave on a free transfer
Ohtani.
next year.
Same thing with Ohtani.
Makes a ton of sense. They want to get some money for him, but does he want to go to Saudi Arabia at the peak of his career? I don't think so.
No, he decides.
There's a man who wants to go to Real Madrid.
I mean, if he wants to go to Tots, he goes to Tots. I mean,
I think it's incredibly unlikely he goes to Tottenham.
Mbappe and Harry would be a successful thing. I'd pay for that.
Harry's going to Bayern.
If they raise the price of that little mince meaty thing you made me eat there, I'd pay
Pies.
for it.
You think they can put up the price of pies to
They
get
put up the
Kylian
price of
Mbappe?
pies.
Tuesday morning. Good morning to you. Equities look like this on the S&P 500 in positive territory. Just a little bit. A mild move higher by 0.06% on the S&P. On the Nasdaq 100, positive by 0.26%. It's going to be a lot of attention on that index later on today. Some big weightings start to report, including Alphabet and Microsoft. Then on to Meta on Wednesday. In the bond market, 2-year, 10-year, 30-year. slice up the yield curve a little bit. We're down by 4 or 5 basis points on a 2-year to 4.87. 10-year higher by a couple of basis points, 3.89.83. Lots of data through this week, but the main focus, the big attention point, is going to be Chairman Powell tomorrow in a news conference with a Fed decision and potentially, probably, another Fed hike, Tom. The 2-day meeting commences in Washington a little bit later.
Really important point. And I can't emphasize enough, John, how all my radar goes up on any central bank when no news is expected. That's when they want to deliver the message. They don't want all this anticipation garbage. They want Mike McKee to stand up in the middle of the press conference. People are nodding off. Michael say something, and Powell will pick up a piece of paper and read something that matters. Will we see that tomorrow?
Mike McKee, looking forward to his question in that news conference
I'll
tomorrow.
have to wake up for it.
6 days of euro weakness in the FX market against the dollar. Longest streak going back to September of 2022. You remember late September, sub-parity, dollar strength, king dollar. Well, we're back to about 110.46, but we have come lower. We were talking about an 8-9 day winning streak for the euro only a week or so ago. That's turned around. The data in Europe, Tom, just not great, and the euro weaker. Dollar a little bit stronger again this morning.
A lot of micro data there as well. One thing I am watching is attached to the United States is the Mexican peso, and the Mexican peso continuing to show a persistent strength. There's a lot of other stories in FX as well, but I do agree Euro's front and center, and on a blended basis, DXY shows some recent strength.
Well, let's get to those other stories. Under surveillance this morning, tech earnings ramping up with results from Microsoft and Alphabet after the closing bell. Investors looking to see if the outlook for artificial intelligence, AI, can continue to justify this massive run-up we've seen this year. Look at these gains. Microsoft, 44% higher year to date. Alphabet, Tom, at 38.
I don't buy it. Are they up because of AI and all the blather, or are they up because of their growthiness and the premium of growthiness? I don't think there's any difference, John, between Microsoft and LVMH. Louis Vuitton is the same as what they're doing out in Washington State. It's about growth, growth, growth.
The dominance of US tech continues. You've mentioned some European names. The backdrop for the European economy. Take a listen to this. So we get a bank lending survey from the ECB. It was published today, and it showed demand for corporate loans in the Eurozone sinking by the most on record in the second quarter. The rate hiking cycle we've seen so far, Tom, over the last 12 months, clearly hitting demand for mortgages and consumer borrowing too. But this is happening pretty quickly in Europe. Germany in recession.
Yeah.
Demand for loans dropping off a cliff, and the ECB set to hike into it on Thursday.
And under surveillance here is a simple fact. It's not the same as America. We are more equitized. Michael Zivas at Morgan Stanley knows this, John. It's an equity world in America versus Europe, which is much more loan-based, much more bank-based. So when you see loan demand down, it's got a bigger wallop in Europe.
Through the banking channel.
Yeah, you lived it. You know it.
Yeah. Well, we saw that. When they were trying to ease that was a problem.
Yeah.
Because we didn't have the credit markets in quite the same way that you do in the United States. I want to turn to China and just wrap things up. So this time yesterday, we got some headlines from the Politburo, the leading policymaking body in China, led by Xi Jinping, of course. They came out with a range of efforts, stimulus measures, potentially in our future, saying all the right things. This is the reaction to that this morning and through the session over in China. The Hang Seng China Enterprises Index, which of course tracks the major Chinese companies listed in Hong Kong, gaining more than 5%. So the biggest pop, Tom, going back to November. And you remember November, that was the talk of China reopening and all that good stuff. So bit of a pop this morning.
I'm going to look at the Kospi. I've always looked at like the DAX. The DAX is the German index, John, is the roulette wheel of Europe. The roulette wheel of Asia is the Kospi, the Korean stock index. And the answer is it pops up right to +2 standard deviations, and that's at Asianless. OMG, China's going to save the day. Everything else picks up, including South Korea.
The rest of the world looking to China. You talk about
See how I
South
did that?
Korea
Under
looking up
surveillance, we looked at Germany and China at the same time.
That was
It's
wonderful.
just, it's a beautiful
That's
art.
the whole point of the practice.
Michael Zizov just teared up.
I'm sure he did.
emotional.
But Europe needs that stimulus as much as anyone at the moment.
Oh, yeah.
The European Central Bank, maybe this is what they want. Maybe this is the slowdown they desire. But if you're long European assets, certainly you want some encouragement.
This is a joy. Let us segue here right now to Michael Zizas. He's out of Georgetown with tours of duty along the way, particularly in municipal finance. He is now global head of fixed income research at Morgan Stanley. And I can't say enough, Michael, of the idea of a guy with massive policy cred like you and municipal bond, the granularity of municipal bonds in America. doing global fixed income research. What does your skill set bring to this new position at Morgan Stanley? To me, it's radically different than most, quote, global heads of fixed income.
Well, I think at a very high level, developed markets in general have had this interaction with public policy that we used to just really be the area for emerging markets, right? So I think you need those interacting skill sets. And even like a day like today and tomorrow where we're waiting on the Fed, I think it's important to understand the public policy nuance behind all of that, right? So one of the reasons that we're so constructive on the bond markets right now is that the Fed has kind of, over the last 18 months, gone over this trajectory where it was creating substantial uncertainty in the bond market in order to deal with inflation that arguably was created by some of the fiscal policy choices made along the way by the U.S. government and by both parties. Understanding that trajectory means that whether or not the Fed goes through with that second hike in September, that they're signaling that the job is almost done or that they've almost got inflation under control as they feel they do. So you switch from massive uncertainty in the bond markets, creating volatility in the way that I think municipal bond investors understand that if you've got elevated volatility and you've got negative total returns because yields are going higher, that regardless of the fundamentals, that's a really negative backdrop. We're kind of reversing that and putting it on its head right now.
I'm fascinated by when I look at fixed income in the equity market, we all have a legacy of shadows and opaqueness out there right now. All my radar is up on this opaque word loans or leveraged loans or that. Does Morgan Stanley fixed income research feel there are challenges in the fixed income space, shadows that we really can't observe?
Well, yeah, absolutely. I mean, so for example, once we get into 2024 and then really escalates through 2028 in leveraged finance, there is a substantial wall of maturities. And unless you get a meaningful amount of free cash flow growth, you're going to get net interest coverage going down substantially. So, for example, if you assume, which I think is a far too conservative assumption, that you don't get any free cash flow growth, about a third of single Bs all of a sudden have sub one times coverage. So that's a real challenge, and arguably it's one of the structural challenges that's kept spreads relatively attractive. Another one that's kept spreads relatively attractive is the bank demand issue and how that's changed since the regional banking crisis. So these are things we have to watch on the horizon. There's secular headwinds, but I think the setup for high-grade bonds right now is pretty positive, at least into year end, because you're taking away this uncertainty from the Fed and fighting inflation.
Something we've been digging into over the last week or so is who is actually paying these market rates. And a question I've asked, and if you could give us an idea, don't expect the precise numbers, but just the difference between what a company's coupon is right now from debt issued in the last couple of years to what the market rate for that interest is if they came to the market today. Just how wide is that?
Well, okay, so our chief cross-asset strategist, Andrew Sheets, wrote about this on Sunday, and it's fascinating that in a lot of ways across the capital structure of markets, the bond is yielding more than the asset that's financing, which is totally upside down. So the investment grade corporate credit index yields about 5.4%. The Russell 1000, the earnings yield is only about 4.8%. That's not totally unprecedented, but it's pretty unprecedented. It's only happened 2% of the time in the last 20 years, right? That difference kind of makes sense if you thought that we were about to accelerate economic growth pretty substantially, but we've got the opposite view. Our economists think we're continuing to slow down. Obviously, we haven't slowed down as much as we thought we would, but without that growth, then there's a problem if you're having to finance with a higher yield than you're actually earning from.
Tom touched on this. When does it start to bite? Can we just build that out just a little bit more? It's going to bite certain parts of the economy and certain issuers more than others, quickly than others. But just on average, when does it start to bite?
Well, I think it's already starting to bite, and I think the last CPI print sort of showed that, right? And it's part of the reason that our economists, I think if they were here, they would tell you that the Fed, yes, they're going to hike this month, but I think ultimately are probably not going to hike in September because the accumulated effect of everything that's being done so far is going to be tightening in and of itself over the course of the rest of the year. So that is also a good setup for bonds and bond yields and total returns.
What does the Bloomberg Total Return Index do off Lehman and Barclays? I'm looking at a Microsoft. I picked Microsoft, folks, just because the earnings up. Believe it or not, Microsoft does have debt. I don't know if you were aware of that. I go out 10 years, the Microsoft 2 5/8 of 33, and I've enjoyed a Tom Keene price decline from 130 down to 97. What's the likelihood, given high rates and sustained high rates, that we see a price breakdown through the lows of the last number of months?
I don't know that you necessarily get a substantial price breakdown. I think a lot of the return you're going to see is going to come off of yield and coupon, mostly because while the Fed could be closer to the end being done hiking, there's still the secular headwinds that we talked about, right? There's still the bank demand headwind. There's still some lingering credit issues. So it's not necessarily an environment where you're going to get yields moving a lot lower or spreads moving a lot tighter, but clipping that coupon in and of itself is quite attractive relative to equities, which are probably going to be more challenged in our estimate.
It's like channeling Mike Wilson there. I mean, you see how
Is that what you think?
It's channeling Mike. How much do you and the equity guys talk to each other? I'm fascinated by that. I mean, Mike's making all the headlines today, talking about the challenges of a bear market call. He hasn't changed his view as well. But how much does fixed income at Morgan Stanley go back and forth with equity?
Oh, the collaboration is constant. Yeah, I mean, we sit on the same floor, we're by each other, we're on calls weekly, collaborating, making sure that we're challenging each other. So the answer, in short, is a lot.
Michael, this was great. Yeah. It's good to see you. Thank you, buddy.
Thanks so much for having me. Appreciate it. Thank you.
Yeah.
Just awesome, as always. I want to turn back to GM. So this is what's happened in the last 41 minutes or so.
I am not
so General Motors... What was that?
I'm not up to speed on this. Go ahead.
Okay. Yeah. I'm trying to do that now.
Okay.
So 41 minutes ago, General Motors came out and released some partial results in Chinese on their own website. And then Tom released the actual results 30 minutes after that. But all you need to know so far is they raised their outlook for the year. And the stock, Tom, slightly positive in the pre-market.
I wonder what it's going to do to embargoes. I mean, the first thing I thought about, John, is this whole embargoed fiction in an age of digital speed. I'm sure they're sitting there in Detroit, and frankly, every company is looking at this and going, what's the value of making that mistake with some form of embargo process?
It's not clear to me that anyone broke an embargo here, Tom. This was them publishing it on their own website in a different language.
Clumsy. I mean, it's really brutal.
Slightly bizarre.
Yeah. But there it is, and, it's good numbers. I've got the presser in front of me. I guess I go with it from Fort Worth, Texas, second quarter, it's GM Financial. Reporting some good numbers. I don't understand, John, how you make money here over long term. I get the idea you can get a cyclical pop in the auto companies as well, but I'm looking at GM back. You can do this on the Bloomberg, folks, on the TRA screen. Wow, it's made 3.5% per year last 10 years. Minting money. I just, I don't get it. I mean, I don't get Tesla either, so.
Well, Tesla got hammered last week off the back of disappointing earnings. Netflix did as well. So let's see if we get the same fate for the likes of Microsoft and Alphabet a little bit later after the closing bell this afternoon. That's where the attention's going to shift to. Some of the heavyweights of big tech reporting after the close today. It's on to Meta on Wednesday. Tom, I was led to believe that Amazon came out this Thursday. It actually comes out next Thursday.
Yeah.
Alongside Apple.
Yeah, I got that wrong. That was my fault. We got the date calendar wrong. And, it happens there. And one of the great things to do, folks, on the Bloomberg, the DES screen really will give you the guesstimate. I think, John, is the best way to put it. The estimate of when earnings will come out. Some of the companies are really repetitive in that, and others a bit of a surprise. But Amazon, I believe, comes out with Apple on the same day. It's a trifecta.
Next Thursday after the Bank of England.
Yeah.
We get a trilogy of central bank decisions this week as well. The Federal Reserve two-day meeting begins today. The decision is tomorrow. It's on to the ECB on Thursday and the BOJ on Friday. We'll talk about some of that with Heidi Kribo-Rediker of the Council on Foreign Relations. That conversation just around the corner. Equity futures right now on the S&P 500 positive by almost 0.1% from New York. This is Bloomberg.
Regarding the ECB, yes, I think it's very likely and it would be reasonable to pause. I think currently it's unclear whether the inflationary pressure has been overcome entirely. We know that core inflation is quite stubborn. So I think how this goes on is an open question. But in the current situation with the weakening economy in Europe, I think it would be wise to halt.
That was the IFO president on German business confidence, which is not great, going into an ECB rate hike decision on Thursday, which most people anticipate will deliver one. Another 25 basis point hike potentially from the ECB president, Christine Lagarde, and the governing council, even as the PMIs look pretty terrible. But inflation is still a problem. And I think this is the lesson for maybe the rest of the world right now is that you can have a weaker economy, Europe, and still have an inflation problem. Europe. That is the nightmare scenario, I think, Tom Keene, for Chairman Powell and co. a little bit later this year. Right now, as far as things stand, he doesn't have that problem. The hopes and dreams of a soft landing are still alive, encouraged by the data we've had in the last couple of weeks.
I don't know how to weight this. The movable pieces of a Fed, and of course the theme of this summer is American exceptionalism, the Bank of Japan, a complete theoretical mystery, and as you mentioned, the complexities of Europe. But what I would emphasize, John, is too much of the fancy analysis doesn't mention the small issue of a war in Ukraine. There is a legitimate war going on in the continent of Europe right now. That's not mentioned enough within the economic, the finance, the investment talk.
Well, the crisis of Europe that wasn't the energy crisis, Tom, that they managed to avoid through the winter, that was the good news for the European economy. That was the good news. What we're starting to see this summer, though, is some real economic weakness start to emerge. Now, some of that's by design, because of the rate hiking cycle of the ECB. And you see some of that in the demand for loans that came out this morning. But have we got to a point now where the ECB needs to back away? It's going to be a really interesting decision on Thursday. I think the Thursday decision is far more interesting than the Federal Reserve decision tomorrow.
With all the heritage of the Bundesbank and such, it's going to be great. We need someone to synthesize this right now on a global basis. Heidi Krebel-Redeker is Senior Fellow at the Council on Foreign Relations and is really quite good at tying in all these different threads in a hugely confusing post-pandemic time. I want to go to one of your headlines, Heidi, which gets out front and says this could be a successful Fed. It could be a successful Jerome Powell. And you state we need to begin to frame the idea of Powell as hero. Discuss how the chairman of the Federal Reserve System could be a 2024 hero.
Well, I think you have to give him a lot of credit for coming through COVID. I think we all have we've blocked out part of COVID, but the fact that he managed through COVID, that he is defying many expectations, particularly of the macroeconomic priesthood that he is not part of, who very much doubted that he would be able to navigate the waters coming out of COVID. And so we do have the higher probability of a soft landing. And if he is able to stick that, I think that he will be, it will be a heroic feat. He is aiming for that balance in both labor and taming inflation. But we have seen a lot of progress. We are seeing that balance fall back into much more manageable space, and all of the debate over the past several weeks over whether he should change that 2% target, I think, missed the fact that there's a great deal of credibility tied to that 2% target, and that I don't think he will change that over time.
Within your writings for Foreign Affairs, you're a great student, as John mentions, of Europe, and I'm really interested in how you feel the inflationistas, the Bundesbank, maybe Netherlands is in there, Austria, how the core of Europe and their ancient concern for inflation, what power, what sway they hold at the ECB right now.
Huge sway. And I think that the focus on the ECB's decision this week is key. Christine Lagarde I don't think there's a lot of debate about what we're likely to see both out of the Fed and out of the ECB this week. But there is a history of fear of inflation and much more concern about growth in Europe right now. And we do have to remember that, as you mentioned, there's a war. War is inflationary. We're seeing grain ports bombed by Russia. There is a chance that we could see weaponization of energy again and prices spiking in Europe this winter. Europe is not ready for an all-out spike in energy again, and you can't just pray for good weather as a strategy. So I am slightly concerned that this winter might be a tougher one.
Heidi, how much of this slowdown we've seen so far this summer before we get to winter, how much of this slowdown is by design? That the ECB actually wants to see this take place?
So again, it's a matter of balance. It's a matter of balancing growth, bringing down inflation, and then I think we also have to look at what's happening in China, given the weight of the Chinese economy in the global economy, because you do have a slowdown that could have shocks on the global economy that we might not be paying as much attention to.
So the Politburo came out yesterday with a range of measures, a lot of rhetoric in there about supporting consumption domestically, doing things for EVs and all of that. Heidi, I was reading through some of those headlines and I was just wondering, how much of this should I take seriously? How big is this effort? What was your take on things?
So I think that the political messaging is stark. You had the party and the state council come out last week with measures with very deliberate messaging that the private sector will be supported equally to SOEs. You have a lot of messaging and meeting with investors, with large institutional investors. They want investment. The rhetoric has to be met with deeds and what it will take to get those to get that investment back. It really has a lot to do with the transparency, the lack of transparency heading in the wrong direction,
right,
with the fact that you could actually see a reaction that we saw over the past 2 years towards the growth of tech, towards any... Sorry,
I don't mean to interrupt, but I think what you just touched on is the absolute key issue. This is what Heidi Kribo-Redeker is famous for, folks, cutting through the BS. Is China so desperate for our foreign investment into China that it could change the policy certitude of Beijing and the dictatorship?
So you have the messaging. Again, you need the deeds to meet the message. And there has been a significant initiative to message to foreign investors that China wants them back. Whether that will happen, you have a myriad of risks for those investors to come back into the market. And the reality is, as Janet Yellen pointed out, the U.S. is prioritizing in that area of national security over commerce. But the Chinese do that on steroids, and they have done for quite some time. So you do have to balance those risks if you're going back in full throttle to the Chinese market. And I think it really has to do a lot more than words to get people back to where we were pre-COVID.
Heidi, thank you, as always, for joining us. Heidi Kribo-Redeker there of the Council on Foreign Relations on some of these central bank decisions still to come this week and some of the challenges domestically, the effort to balance opposing forces in places like China.
People go, why are these people on? This is textbook Heidi Kribo-Redeker, where she talks about the greater theme of China and all the things spinning in her head and distills it, John, right down to what do the Chinese need from us? They need investment. How can we give them investment given the politics and given the micro decisions made out of Beijing? Frankly, also the micro decisions made out of Washington.
I think we're still waiting for that outbound investment restriction package to come from Washington, right?
Well, we're going to get the actual package, but I think there's the action of corporations as well. They're sitting there going, what's the easy answer right now if you're a corporation? Well, it's delay. I mean, unless you're X. X can be out front with an investment right now.
I would love the backstory on what happened over the weekend with that Twitter effort. I've got no idea.
We should have Linda on.
No
Linda,
idea.
come on, man. You watch every morning.
I don't think she wants to do media right now, but I mean, we can try. Dan Greenhouse of Solace Alternative Asset Management joining us shortly. Big day, big afternoon for earnings. Coming up a little bit later from New York. This is Bloomberg.
The real growth picture is pretty poor everywhere.
From an economic perspective, I think all of us expect a deceleration, a slower economy.
This is the environment where you have to be more nimble.
We're cautious and think that the conditions are there for a full-blown recession.
I think we're going to get a lot of clarity this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The week begins today. Live from New York City this morning. Good morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market positive by 0.1% on the S&P 500. Bramo's still out. She's going to be back with us tomorrow for that Federal Reserve decision.
So she says.
Then on to the ECB on Thursday, the BOJ on Friday, and tech earnings kicking off in a big way later on this afternoon. Microsoft and Alphabet just around the corner after gains of in and around 40% year to date on those two names.
Yeah, this is going to be interesting to see. We're going to dive into earnings season. The guest we've got coming up here in moments is enthusiastic about earnings and the upside and all that. I want to also note here, John, that one of the great things here is that corporations adapt, and we see that moments ago, Biogen out. Forget about the numbers, and there's a headline, plans to cut 1,000 jobs. What's critical there, John, is they only have 9,000 employees. So that's like a real cut. Just the headlines don't matter. It's a percentage change on right sizing. How will the banks right size? Will tech continue to right size? These are some of the questions on the conference call.
How much more multiple growth can we get from just talking about AI repeatedly, Tom?
I think it's a valid, you know where I am on this. I don't believe in it. I was polite with Anurag Rana, but I think you're dead on. AI, EIEI, AIE,
We're going to count how many times that phrase comes up on earnings calls a little bit later on this afternoon.
I'm going to cut him some slack. I don't think it's nanotechnology, which I thought was complete BS from the get-go. The nano. Remember the nano 10 to the minus
that was
9?
good.
But the idea is there's some substance here, but what I hear from the adults like Anurag Rana and Mandeep Singh is you go out. Mark Mahaney's on later today. You got to go out in time.
Looking forward to catching up with Mark.
Yeah.
We'll do that about 9:40 Eastern time on some of the tech earnings later. Got a great guest with us right now, so let's get straight to it in the equity market. Equity futures right now on the S&P 500, positive by 0.1%. There is a lift here. In the bond market, yields a little bit higher by a couple of basis points. Your 10-year, 389.24. And here's this move in the euro. It's not a big one on a daily basis intraday, but it's relentless over the previous 6 days. 6 days of euro weakness. We had this string of euro strength, now replaced by euro weakness, 110.45, negative 0.2%. Fact of the matter is, the data in Europe at the moment, Tom, does not look great, and the ECB is about to hike into it on Thursday.
No, they're going to hike into it, and it is the biggest risk. I think we've identified that right now. But I'm going to go, there's no Jackson Hole there. They had Sintra already, but what's the debate on ECB into the Q3, into Q4 as well? And I think, there's a huge mystery about Q3, Q4 in economics. Some of that will be clarified at Jackson Hole.
President Lagarde, Thursday, before we get to Jackson Hole
We
next
have her
month.
on the show?
We don't.
Oh.
She has a news conference, though, which you're welcome to
Sorry.
attend in Frankfurt, Germany, if you'd like me to fly you out.
Yeah, that's good.
Dan Greenhouse, Chief Strategist at Solus Alternative Asset Management, joins us around the table. Dan, good to see you.
Good to be here again, guys.
TK gave us the spoiler there. You're optimistic on earnings season, pretty constructive. Tell us why.
Well, listen, first of all, let's look at who's already reported. The airlines have told us demand is quite strong. The home builders that have reported thus far have said demand is quite strong. The banks were terrific. I think an underreported story, and I'm a nerd about conference calls, but an underreported story was the CEO of PNC Bank. PNC is obviously not JP Morgan or Citigroup, but it's a tremendously large bank with an enormous loan book. And when asked about the current state of the environment, the CEO of PNC cut himself off mid-answer and said, we aren't even having a soft landing right now. The economy's been quite strong. And so from my standpoint, I think that's going to translate into actual operating results. Obviously, that hasn't fully materialized as of yet, but I've been pretty optimistic over the last couple of weeks that this is going to be a better than expected earnings season, more so than it normally is.
For the gloom crew on the income statement, where's the greatest misjudgment? Is it revenue? Is it down the line? Is it this input cost debate that's out there right now? Where's the thing that gloom crew is getting most wrong on the income statement?
The gloom crew is probably a pretty small group at this point. I mean, price action has eradicated much of that group. I think there is concern on the top line. I mean, there's a pretty good relationship between nominal GDP growth and nominal earnings growth in the S&P 500. And as inflation comes down and nominal GDP comes down, that top line growth has slowed and is continuing to slow. So I don't mean to suggest that all is well. What I think I'm operating on is more of a relative argument than an absolute one, that some of the more negative arguments that were put forth for much of 22 have unfortunately fully carried over into 23, and they don't appear to be materializing the way, obviously, some people expected.
You and I sit on the conference calls, and you get a character there. What is the character of tech conference calls this week?
Well, listen, I think to John's point earlier, they're going to try to ride this AI train as long as possible.
They're really going to climb on board it.
I mean, listen, we've all been around the block a few times. How many times have you seen the same headline hit the tape and goose asset prices repeatedly? And how many times can you throw up your hands and say, we already know this, and it works every time? And I imagine on the AI side of things, that's probably going to be the case again. Although, admittedly, this is a real thing. It's not, presumably, orders are materializing. Companies are actually implementing this in a material and perhaps cost-effective manner, and that's going to have real-world benefits for companies in the immediate. And so I think that can be measurable, and ultimately it may not just simply be the same headline over and over again if the data continues to back it up.
You know the new obsession, the catch-up trade, the rally broadening out, time to rotate away from big tech. Where do you stand on that now?
Well, listen, I mean, the rally is and has been certainly broadening out. And to be clear, through the spring, it was undoubtedly the so-called Magnificent Seven. I mean, there's a bit of revisionist history going on that somehow the broad rally has always been the case, that it's not just 7 stocks. For a long period of time, it was just 7 stocks. But you have a tremendous catch-up now on the part of small and mid-caps, as we know, and the rest of the index is playing a bit of catch-up as well. And a lot of that has to do with the economy not being in a recession. I think we talked about this last time I was here, that around the middle of this year was when, excuse me, my group expected something resembling a recession or a worse economic environment would materialize. Now it seems pretty clear that we're here. Not only is that not the case, but we're very unlikely, as it stands now, to have a recession even this year. And if that's the case, you're going to start to see, and now indeed have seen, a rotation away from the big names into the other names, because the supposed economic weakness that I forecast, and by extension the earnings weakness that would materialize as a result, is certainly not here.
How sticky is that money in money market funds? Far more interested in the rotation that could develop there than maybe from tech to cyclicals. What does that look like?
Yeah, I don't have the answer. I mean, listen, you're getting 5%. If you go a little bit out on the risk spectrum, commercial paper type stuff, you can get 6%. And so from a return standpoint, if you build a portfolio or you just adjust your portfolio to have a core of 5 or 6%, let's say, and then around that you build a diversified portfolio of high yield bonds, corporate bonds, and equities, you can have a pretty attractive return stream with a lower beta that for most people, institutional and otherwise, is probably not an unattractive return stream. I mean, for us, we do a lot of higher risk, high yield bond distress type investing. And that return stream is going to be considerably more volatile no matter what. But on balance, I think when you can have a core of your portfolio returning 5.5%, 6% on 90-day paper, that's really hard to argue with.
Does diversification work here, or is it a time for more concentrated bets?
Well, listen, in general, I subscribe to the Warren Buffett, I believe it's Warren Buffett line of thinking, that why should I put my money into my 6th best idea when I can put more money into my 5th best idea? And I think there's
that's the John Ferro theory.
John Ferro, Warren Buffett. There's
what's the difference, Dan?
It's very hard to tell them apart. But on balance, I subscribe to that. But we're institutional investors managing hedge fund money that's presumably long-lasting and sticky.
8 months.
Depends, but for a lot of retail investors, I think it's very hard for them. They've been taught, and financial advisors have been taught for years, that diversification is a benefit both within sectors and geographically, and I don't think that's going to be a thought that's going to break anytime soon. And to a large degree for that investing class, I don't think it is an idea that should be broken anytime soon.
Let's talk about high yield just to wrap it up.
Sure.
Up in quality is the buzzword, the phrase that I sort of get thrown at me every time I talk about credit. People just say, yeah, we're up in quality, whatever that means. Can you tell me what you're doing in high yield specifically, what the opportunity set looks like, given how tight we see spreads on a daily basis at the moment? I think near the tights of the year currently.
Sure. Well, listen, coming into the year, that was the argument. You want to be up in the capital structure. You want to be safer because for the same reason that the equity market was supposed to continue moving lower, those safer parts of the capital structure were supposed to outperform. That hasn't been the case. Loans, which are higher up in the capital structure, and have a first claim on a number of assets, they've done better this year than have high yield bonds. And so much like what's happened in the equity market, that part of it's been a bit of a surprise in the corporate bond market. For us, we're not like a closet index or we're not trying to do those capital arbitrage trades. We're an absolute return vehicle. And for us, lower in the capital structure has been rewarding. We've done a lot on the energy space. although admittedly there's very few distressed or troubled energy companies anymore. But further down the capital structure, what we found was there are a lot of companies in the consumer and leisure side of things that look mispriced to us. And where our performance has been generated this year and continues to be generated is in a lot of those names. If you look at things like hotels and movies and cruise lines and anything that public events, anything that involves the consumer doing things, we thought was mispriced and in a large degree continues to be.
We've seen that in equity in a massive way for the cruise lines. I mean, that's just been its own story. The default cycle, are you seeing signs anywhere that it's starting to pick up?
Oh,
just
sure.
a bit?
It's listen, you're back to about average default rates, which isn't saying very much, but on the back of very large structures, relatively speaking, like Envision Healthcare, the default rate has started to tick up into, let's call it the 3% range. And I think my expectation is that that's going to continue if you include what we call distressed exchanges. My expectation is that default rate is going to continue to tick up. But I think this is an important story that Chris Pacillo, our CEO, has told investors for as long as I've been at the fund. You don't need an economic cycle to have a default or distress cycle. And we've seen this repeatedly throughout history. And I think that's what you're seeing now, a pickup in default, a pickup in distress activity that's independent of an economic cycle that appears to be holding in there quite well. But the interesting story is going to be 6 months, 9 months, 12 months down the road if the economy does indeed fall under the weight of what the Federal Reserve has done, and there's no guarantee that's the case, then what we've seen thus far is just going to be the tip of the iceberg.
It's been absolutely fascinating the last 12 months. Dan Greenhouse, it's good to see you, Dan. Come back soon.
Thanks, guys.
Dan Greenhouse there of Solace Alternative Asset Management, TK, on this market. A more constructive view there on earnings, and particularly a little bit more constructive on some opportunities in high yield that I think we haven't heard much of over the last few months.
Well, the linkage there to Solace to the high yield, and as Lisa has mentioned as well, the spread market speaks volumes, and that people are voting for high yield, maybe as they're voting for, retail's voting for equities to sustain. I would go back to my arch theme, which is companies adapt, and that's what we're seeing right now, whether it's General Motors or Microsoft this afternoon. I don't, here's a headline. I just noticed the paint company, John Sherwin-Williams, is a all-American name of paint. John, you get a new place, John, you move into a new place with 4 bedrooms and
Are you buying
the view. No, I'm thinking of other people.
Okay.
You got to go out and get 15 gallons of Sherwin-Williams paint. The answer's up 6.3%.
Beat and race from them from New York. Welcome to the program. If you're just tuning in, the S&P 500 currently positive by 0.1%. Coming up in about 30 minutes from now, we'll catch up with the General Motors CFO after they raised their guidance about an hour ago. TK, GM this morning, General Motors, the CFO, a little bit later this hour.
It's going to be interesting to see what he says. I mean, that's all there is to it. He's an Auburn guy. He's a Southern guy. Gets manufacturing down the corridor from the Midwest down to the South, and it'll be interesting to see what he says. There's some distractions here with the earnings announcement this morning and this embargo stuff and all that. But the real distraction for me is EV. What do they do, and frankly, what do others do with EV?
And whether this is it, whether this is really
no, you've been
the
the one.
deal.
Yeah, but you have nailed the thing I can't get an answer to. Dan Greenhouse probably knows the answer. Are EVs thermodynamically on an energy basis, are they a plus versus internal combustion? I don't have an answer.
And what happens in 10 years if everyone was wrong?
I don't.
And they're sitting on these massively expensive investment cycles.
Why is it so hard to find the
pile of
answer to
debt?
this? That's what I don't understand.
Well, they're committed to it, that's for sure. And they're not alone, and they've been rewarded to it in the equity market in many cases. Equity futures on the S&P 500 positive by 0.1%. Marilyn Watson of BlackRock later this hour from New York. Good morning.
Part of the argument against high yield this year has been the spread's not interesting at all, and but you can create. I mean, there are a bunch of parts of the fixed income market that actually you are getting paid for. There are parts of credit. By the way, European high yield, if you're a dollar investor, you swap it back to dollars, and you get paid well into the 9s for getting that. That strikes me as fair.
That was Rick Reeder, Global Fixed Income CIO over at BlackRock, talking about the opportunity set in fixed income. It is summer, Tom. He's allowed to be tanned and rested.
Unlike you and me.
Tanned and not rested. I don't know about you, TK.
No, I'm not.
Busy summer gets busier this week, that's for sure. Tons of earnings, lots of central bank decisions going into it. Equity futures at the moment on the S&P, slightly positive on the S&P 500. Just a small lift, Tom, to kick off this morning, this Tuesday.
Yeah, very importantly, John, here, we haven't mentioned it today as well, but the Bloomberg Financial Conditions Index shows the accommodation Chairman Powell does not want. It's pulled back a little bit in the last 24 hours, but decidedly more accommodative than anybody within central banking would like to see. And that augurs for 25, maybe even another Andrew Hollenhorst kind of 25 on top of that.
To state the obvious, given the recent data, I'd say he's less concerned about that now than he was 12 months ago.
Yeah.
Very different backdrop for this Fed chair.
Yeah, maybe Dan Greenhouse is advising Jerome Powell. And
You reckon?
Calm down, earnings are going to be fine.
Hey, some optimism there, hey?
Yeah.
It's welcome.
It is. And the optimism today you see in the market with S&P futures up 6. Right now, and this is important, who I would go to is Elizabeth Economy, but Dr. Economy is working for the Secretary of Commerce and is not available for media. She has been definitive on the fragilities of Beijing, Xi, and Chinese leadership. Anne-Marie Horton is our Bloomberg Washington correspondent, and with an announcement made in the last 10 minutes that the former head of foreign policy for Xi will take over again, and the former ambassador to the United States is out the door. This has been widely speculated, a number of good write-ups on this, even in the last 24 hours. Anne-Marie, I'm going to suggest this is not a surprise, but I would suggest there's a massive mystery to this. What does Washington believe happened?
Well, it is not surprised that we have this movement today that was pretty much given a nod from the Chinese government. And yesterday, this was coming down the pipeline. But what we still don't know is what happened to Qin Gang. This is the former U.S. ambassador. He was elevated at a very young age, one of the youngest we've seen in 70 years, to be a foreign minister in China, handpicked. And he's been missing for a month. We have not seen him since he took some diplomatic engagements on June 25th. And there's been a lot of speculation within the Chinese press as well that has not been censored by the Chinese government. One of those that he had an extramarital affair. We do know how China feels when you start to poke around and try to find out what's going on with officials. Maybe a health concern, but we just do not know. When Jake Sullivan was asked about it, he said, "We don't know." Quote, literally, we don't know. So there's going to remain a lot of speculation about this, but China clearly was under pressure to make sure they had an individual to represent them, because some foreign diplomats were also starting to cancel some trips.
I mean, Anne-Marie, that's a beautiful summary that we only get, folks, from Anne-Marie Horton. I would suggest my focus, Anne-Marie, is on the ambassador of the United States to China. Nicholas Burns has been a huge supporter of what Bloomberg Surveillance has done over the years. There's been some recent activity there about emails leaking out and this, that, and the other thing. With this Chinese upset, how does it affect Ambassador Burns' relationship with Beijing?
Well, this is an individual that the American foreign policy apparatus, whether you're an ambassador, whether you're Tony Blinken, you know who Wang Yi is, right? This is an individual that everyone is well versed in. So I'm not sure it changes that much, besides a lot of palace intrigue and concerns over what else is going on behind the Iron Curtain when it comes to Xi Jinping and other members of his government. This is something they keep very close. So I think there'll be a lot of interest into what happened to him until we exactly find out. When you look at Nick Burns, though, of course, this has been just another salvo, really, between Washington and Beijing, and really just heats up the tension. Not just his emails were hacked, but a number of others as well. And obviously, that's quite concerning if you're an ambassador in that country. But I don't think anyone was actually surprised that the Chinese government was trying to hack into their counterparts' emails.
If you wanted to find out what was going on right now, would you call Blinken or Kissinger?
At this moment, I think I would call Henry Kissinger. For the fact is that Henry Kissinger got a meeting that no one in America has been able to get, and that is a sit-down with Defense Minister Li Shangfu. He has still yet to meet with his actual counterpart, Lloyd Austin, and that is because of sanctions that are on him. The Chinese government maintained that until those sanctions are lifted, he will not be able to meet. We should note that having sanctions on this individual does not mean he cannot have a sit-down with his counterpart. But Henry Kissinger is the man that had all the access recently in China. He likely will be briefing the Biden administration, and he's the one I would want to have a conversation with.
Okay, but you're going to be on the plane, Anne-Marie, to Beijing. I believe Biden is going to meet with the Chinese leadership here. I'm going to use November as the operative guess. Does that change here? How is that nuanced in the coming days?
I am definitely not going to be going on a plane to Beijing. If Biden is set to meet with Xi Jinping in November, that will be happening in the United States.
Oh, in the United States,
okay. If they were to meet, we'll be going, all of us, to San Francisco. We'll be waking up very, very early to make sure we hit the 6 a.m. Eastern time of surveillance. But that'll be happening at the APEC summit. Potentially, the two others. The two can also meet at the G20 in India in September. This could be a potential first meeting, but I think if you're going to look for something more substantive, they might want some more time in November. But this is obviously a guessing game. We do expect the two to meet. We expect them to also have a phone call. When is that phone call that Biden says he has been planning to have with Xi Jinping happening? I don't think Qinggang changes any of that potential pathway. But I think there's a lot of curiosity now, or the curiosity has grown now within the United States, within Washington, D.C., about what happened to this individual, especially as he was really a rising star in the Chinese government apparatus.
Well, for the president at the moment, we're going into election year. Anne-Marie, the status quo, the relationship between China and the United States as it stands, is that beneficial to the president?
I think the status quo at the moment is that they are trying to set a floor, which they have been trying to do since November, when Biden sat down with Xi Jinping at the G20 in Bali. And I was there for that meeting. And the whole point of the meeting was to set guardrails and to now conduct Washington to Beijing counterpart-to-counterpart conversations. So what we have seen the last month and a half or so is a number of those meetings take place. Yellen, John Kerry, Blinken went over. But obviously, what has really changed? Not much beside a dialogue that they wanted to do almost a year ago. And we're going to still see this administration come out with more measures against China when they look at national security. This was according to the Treasury Secretary. And we could see as early as the end of this month, likely the end of next month, that executive order on outbound investment will be coming out the door.
And what's great about this, John, is when Biden meets with Xi in San Francisco, what Anne-Marie does is she's not at Charmaine's. That would be, it's too hoity-toity posh for Anne-Marie. She is a top-of-the-mark girl. She goes to the Top of the Mark, which is the iconic World War II bar in San Francisco, and she just goes directly to a 312, a hit with us.
We're talking about bars.
Yeah, Top of the Mark in San Francisco. Anne-Marie's going to do the Top of the Mark and then go straight to our time with us in the 6 a.m. New York hour.
Working East Coast hours on the West Coast is brutal.
It's brutal.
I don't know. If you're listening, the team over at PIMCO, I feel for you.
It's and you never get used to it.
That's
what Mohammed told me. Bill Gross told me that years ago.
Don't know how they did it. I don't know how they're doing it right now, but tough. AMH, thank you. Anne-Marie down in Washington, D.C. Tom, and the latest out of China and the prospect, of course, at the end there of a meeting between the two leaders.
Yeah, and that's within this turmoil in China. I would suggest in diplomacy circles, November's tomorrow. So let's get to it.
Marilyn Watson of BlackRock coming up shortly on fixed income. Torsten Slock of Apollo moments ago publishing about the default cycle. We'll get into some of that too. Equity futures just about positive. This is Bloomberg. Four days of SPX outperformance versus the Nasdaq. So basically the Nasdaq underperforming over the last few days. Equity futures on the S&P look a little something like that. Futures positive by 0.1%. At the moment, the outperformance back with the Nasdaq by a third of 1%. The attention very much on big tech and the weighting of big tech a little bit later. We'll talk about those earnings in just a moment. In the bond market, 2-year, 10-year, 30-year, 2-year yields in 4 basis points. We're lower to about 487. Yields higher by a couple of basis points on a 10-year, Tom. This curve steepening a little bit today with a 2-year yield lower and a 10-year a little bit higher.
Very quickly, I know you want to get to under surveillance, but John, this is in your wheelhouse. And in Bloomberg off the London desk and Paris desk talking about earnings season, not in big tech, but in big luxury. And there's some huge mystery there. I know it's not the size and the capitalization of big tech, but there's some real niceties there about the delineations of luxury, John, which you've mentioned with LVMH and the others.
Weakness in America, apparently. That's what we've heard from, I think, Richemont.
Richemont, which is Cartier, right?
Yeah.
They're the bracelet with the nail.
They do watches as well. Yeah.
You buy a nail for more money than God.
Is that right?
They go to Home Depot, they just take a nail and bend it.
Screw it in. And
I don't know how you get it on and off your wrist, but...
Very fashionable. They were several years ago, and you see some people with them all up their arm.
Yeah, it's like a nail.
Okay, it's a nail. You've described it.
It's number two.
Someone's just like,
yeah, it's what you'd use with a 2x4. I mean, it's.
Okay, I'm sure Cartier's loving this conversation. Let's finish on the euro in the FX market. 6 days of euro weakness continues. 110.44. We're negative 0.2% on euro dollar right now. Let's get to what's under surveillance this morning. Tech earnings ramping up with results from Microsoft and Alphabet after the bell. After the close, investors looking to see if the outlook for artificial intelligence can continue to justify just a monster run-up so far this year. You're familiar with the gains, but I think it's worth going over again. Microsoft up 44% year to date. Alphabet, call it Google, up 38%, Tom. What a move. What a move so far in 2023.
Big moves, and then you say, well, that's it, and that's the zeitgeist right now. I love how Dan Greenhouse pushed against that 10 minutes ago on the show, and it's a character of earnings, and of course, again, as in every sector, the conference call is everything, away from the AI, EIO idiocy. It'll be interesting to see what particularly Microsoft says just about the 3-year strategy, cloud, enterprise, the rest of it moving forward. It's a mystery.
Ad spend over at Alphabet, YouTube as well, given how competitive streaming is.
Yeah, I'm not up to speed on Google other than they're the search engine, right? And we spent 10 years being wrong. The search, it's over. It's done. Google's
I thought Bing was going to take over.
Bing, exactly,
Bing's
precisely.
Take over.
I used Bing once. It was like Threads. I went to Threads, went to Bing and said goodbye. I mean, that's the truth.
Threads, Instagram, Meta.
What else is under
tomorrow? If you want to understand the euro weakness, look at the data. PMIs yesterday, business confidence out of Germany. And look at this too. The lending survey published from the ECB today showing demand for corporate loans just dropping off a cliff, sinking the most on record in the second quarter. This rate hiking cycle, as you might expect, hitting demand for mortgages and consumer borrowing. But Tom, we're seeing a slowdown there. You see it in demand growth.
Yeah.
You see it in the economy.
The banking pros, Allison Williams and others, everybody talks about the drama, the stuff Chanel Bassett talks about. The bottom line is the nitty-gritty, the Brian Moynihan of it is, what are we actually doing with deposits? What are we doing with loans, net interest margin, and all that? This is on the loan side. As I mentioned in the last hour, to me, it's a hugely important overweight in Europe because of the bank loan fixed income nature of Europe versus the financialization of America.
European Central Bank decision on Thursday with President Lagarde anticipated to hike interest rates. The ECB story right now is not the same as the story at the Federal Reserve and the United States. It's just not. It's just become really, really different. And as someone pointed out to me a little bit earlier this morning, just to state the obvious, different mandate as well. Singular mandate for the ECB. It's inflation. Got to hit it. In the United States, labour market, full employment, inflation close to 2%, all of that good stuff.
I take the point on that. I think it's very, very important. But with that said, it's about, are they beyond eurosclerosis? And this is what we talked to Gentiloni, the former prime minister of Italy, about at the IMF meetings. I mean, I don't hear anybody talking eurosclerosis. We've moved beyond that, maybe to a better place. But is there a buoyancy to the entire game? I'm not sure.
Kit uses SocGen this morning in his morning note, writing that if you want to see sustained euro strength, you've got to see something big coming out of China. My words, not his, but that's what he was alluding to. Stocks in China actually rallying today after pledges yesterday from Xi Jinping and the Politburo, the leading policy body over in China, led by, of course, Xi Jinping, to boost economic growth. So you've got the Hang Seng China Enterprises Index up by more than 5% in Hong Kong today, tracking those big Chinese companies listed there, Tom. That move, the biggest since November, and you remember back in November, that was around the China reopening story. So we've got a bounce there. Let's see if it's sustainable, and let's see what kind of stimulus we actually get from China in the coming weeks and months.
I would emphasize bounce. You look at it on a standard deviation basis, and it's not much of a move here. Yes, it is a bounce. And I'm going to suggest that we would hear from Endicott and Steve Engel and others reporting from China that you can't conflate the diplomacy, foreign affairs headlines of 20 minutes ago into an economic and finance analysis. I just don't think you can bundle the two together.
There's a lot going on there right now, isn't there?
Yeah, I mean, it's
big time.
It's crazy. Futures up for Marilyn Watson briefs now, head of global fundamental fixed income strategy at BlackRock. This is an incredibly important conversation, folks, on what the prescription is forward, which, Marilyn, is to be flexible and nimble. I'm going to editorialize into 2025. How am I flexible and nimble clipping coupons in fixed income?
So in fixed income at the moment, as you say, I think you do need to be flexible and you need to be nimble because it's a very uncertain environment still. At the moment, you can get very attractive carry at the front end of the curve still, also in commercial paper, in some short-dated investment-grade bonds. And at the moment, it pays to actually not take too much duration risk, not take too much risk, but just clip those coupons and get the income. But as the economy evolves in the US and in Europe and elsewhere, as we get more information, from the Fed tomorrow, from the ECB on Thursday, and over the next few weeks and next couple of months, as we continue to see more economic data from the US or from the Eurozone, which, as you mentioned earlier, has seen some pretty weak data in the Eurozone at the moment, then we will continue to see a shift both in the yield curve and in the opportunities that I think that are available. So at the moment, I think it pays to, get the carry, to not take too much risk, but then to be able to really deploy that dry powder when the opportunities arise.
I need to conflate in here, Marilyn, the news now, and it's Torsten Slok writing for Apollo, looking at loans. I mentioned loans in the previous hour. Is a mystery to me, the default rate of high yield and such. Is the market too complacent about what is to come in commercial real estate, what is to come in these strange leveraged loan vehicles, in derivatives within your world? Are we too complacent?
So I don't know that it's too complacent, but I don't think there's a very clear view on the trajectory of the economy going forward. At the moment, our core view is that there won't be a recession this year in the US. We think that the US remains pretty resilient, and while it is slowing, it remains on a pretty solid footing. And when you look at the commercial real estate sector, then it has already been negatively impacted by the very aggressive rate hikes, but as you say, perhaps not as much as some people may have expected. When you look at leveraged loans and elsewhere, you look at, high yield overall has performed very well this year. But I think at the moment, a lot of investors are still looking at really getting in, I think, in a bottom-up fundamentals. So there's a big difference between the different bonds and the different issuers that you can also buy within the high-yield sector, and the spread and the total yield that you can get there as well. But at the moment, I think there isn't really a consensus on the trajectory of the economy and how bad, if it's bad at all, it will be next year. So I don't know that it's complacent. I think there's just not yet enough data for the market to be able to tell.
Let's work through some of this work from Torsten Slok this morning. And Marilyn, good morning. Allow me to share the full quote. Markets are not taking the ongoing rise in default rates for high yield and loans seriously. Many investors argue that this is just normalization, or these are companies nobody has heard about. The reality is that more and more companies are defaulting because the cost of capital is higher. Higher cost of capital is precisely how monetary policy works, by making it more difficult to get financing. The Fed hikes are biting harder and harder, and all investors should have a view on how high they think default rates will go during this cycle. Marilyn, can you have a view on that today? And would that lead you to believe that you should back away from areas of this market which are going to face much, much higher funding costs when they come back to market in maybe 12 months, 18 months from now?
Yeah, I mean, I think you can. And as I say, at the moment, you don't need to take the credit risk in the high yield sector when you can get very decent carry elsewhere, much higher up the credit spectrum. I think also, when you're looking at your overall allocation, when you look at the equity market versus the high yield market, for example, we also like some of the beta in the equity market. So you don't need to take the risk there. You don't need to take the credit risk. So you can take a view. And our position at the moment, I would say, is relatively cautious. It's relatively, high quality. And as I say, we're being very nimble, and we're really steering clear of too much duration risk, although we have added a little bit there. But we're also just being very, very cautious from a bottom-up perspective. And we want to know and understand exactly what we're buying in every single issuer, in every securitized asset, in every investment grade bond. We want to understand exactly the fundamentals from a bottom-up perspective of the issue itself and of the sector as a whole. So I think you can take a view, and at the moment we don't think it pays to take the risk further down the credit spectrum.
You mentioned they're taking on a little bit more duration risk. Can you give us a little bit more colour there? What have you been doing?
So we've added a little bit on the margins because, it is our view that the Fed, will hike again this week and then maybe pause. The Fed itself has indicated in the previous summary of economic projections potentially one more hike, but we don't know that yet. Obviously, we need to see a lot more data to see whether that comes through or not. But we have been adding a little bit more duration in the front end and the belly of the curve in the US. Also, in the Eurozone, we think that the ECB will hike again this week. They may hike again in September, but that's nowhere near a clear-cut scenario anymore, given the data. And we do think it now pays to take a little bit more duration risk, get a little bit more yield, and just to lock in some of those rates.
Not even the hawks on the ECB want to commit to anything beyond this week. Find that interesting. Marilyn, thank you. Marilyn Watson of BlackRock. Enjoy London, Marilyn. It's good to see you. TK, I think that's been an interesting story. The data in Europe's weaker. We've got a decision at the ECB on Thursday with President Lagarde. And ultimately, you've got some hawks on that committee. I think it was Klaas Knot of the Netherlands in the last couple of weeks, who won't commit to anything beyond July, which I think speaks volumes.
Yeah, I've talked to him often, the guy from the Netherlands, Knot, and he's very much more what I'm going to call Anglo-American within his central banking than a lot of the other people in the ECB. But again, it's going to be fascinating, and it comes down to the heart of the matter, to the Lagarde presser. This
Thursday. If you are just tuning into the programme, welcome to the programme. Equity futures on the S&P positive by 0.1%. Coming up at 8:30 Eastern Time, Stephanie Roth of JP Morgan Private Bank will break down some of the economic data we're looking for this week and look ahead to the Federal Reserve decisions, Tom, on Wednesday and beyond. I think September's the one. Again, not just the ECB, but also the Federal Reserve. It's not about this week.
Yeah.
It's about communicating what happens next.
What happens next after Jackson Hole? And I'm going to take it out even further, John. November 1. You go from September 20 to November 1. There's this tradition the December meeting doesn't matter. I don't have a strong opinion on that right now, December 13th. But the combo, September 20, November 1. And it's not so much is somebody going to get the call right or wrong. It's how they amend off of what we see tomorrow. How will Hollenhorst and Citigroup amend? Or on the other side of the coin, how will someone looking, for no rate rises at all, how will they adjust off a 25 beep assumed move yesterday?
That's the new window for expected economic weakness, right? It got pushed out from the start of the year into the middle of the year, pushed out to the end of the year. That's when student loan repayments resume, and that's the new spot for the bears. Back end of the year.
I like what Claudia Sam says, is would everybody just look at the data, and the data is very mixed nationwide, state to state.
We'll look at the earnings next. The General Motors CFO on this program from New York. This is Bloomberg.
China's about 15%, 1/5 of AkzoNobel's revenue base, so it is significant for us. What we're seeing is a market that is better than what we anticipated at the beginning of the year, but is not as good as what we and a lot of people thought it was going to be when China reopened in March.
He's not alone. That was the AkzoNobel CEO on China. China disappointing in many ways. The reopening boom that market participants were looking for didn't materialise. What we're seeing now, some rhetoric to support this economy, and as we've written about this morning here at Bloomberg, potentially Xi Jinping throwing a lifeline to international markets. Equity futures this morning, and good morning to you, look like this on the S&P 500, going into earnings a little bit later on this afternoon, and a whole host of central bank decisions later this week, starting tomorrow with the Federal Reserve. Equity futures, Tom, up by 0.1%. Yields a little bit higher by a couple of basis points, 3.89 in the FX market, euro weaker. Bad data out of Europe again today, 110.47 for euro dollar. And some earnings in the mix before we get to Alphabet and Microsoft after the close later. The headline from General Motors in the last couple of hours, Tom, raising their profit target for the year by at least $1 billion. beating a race.
Yeah, I remember, John, when you whispered to me somewhere in May of 2020, John, General Motors, Tom, General Motors, you got to do it. 20 to 60, and then a challenge last year, to say the least, and now ebbing and flowing here, 35 to 40. It has been a challenge for General Motors, including all manufacturers, through the pandemic, and now they look to profitability. Joining us, their Chief Financial Officer, driving the financial ratios at the complexities of the future of General Motors. Paul Jacobson joins us this morning. Paul, define profitability. Where on the income statement are you zeroed in on profitability out 24 months, out 5 years for General Motors?
Well, good morning, Tom, and thanks again for having us. It's always a pleasure to be with you, especially on a day like today where we're announcing the tremendous results that the GM team put forward. And I just want to extend a great big thanks to them worldwide for the results that they posted during the quarter. You know, when we're looking at profitability, you know, it's a whole range of outcomes. Obviously, EBIT matters, but one of the things I think we've been really focused on, and I think it's worked for us, is the combination of market share and margin and growth. So at the end of the day, it's not just about producing and selling more vehicles. It's about making sure that we're maintaining and expanding our margins going forward. And when you look at the track record that we've had, especially over the last 6 months, but really over kind of the last 6 quarters, the team's done an amazing job producing vehicles that customers demand. Right. And you know, our biggest challenge is we can't get them fast enough, but customers have really responded, and we really appreciate that.
Okay, that's right where I want to go. In that there's a shortage of, you know, there's always in every company 4 or 5 vehicles. Everybody wants the same car. Do you have a lot of pricing flexibility now and into 2024? Can you raise prices?
Well, I'm not sure that we're going to be able to raise prices across the board, but one of the things that we've seen that has really manifested itself is customers demanding higher trim levels. In fact, we created over the last 18 months the Denali Ultimate, which was a higher end trim level than our high-end Denali on the GMC Yukons, in response to customers wanting them. And now what we see when we look at our trucks and our SUVs, about 70 to 75% of them are being priced at premium levels where customers are demanding that. So I think we've done a good job of responding to where customer demand is and what they're looking for in our products. As far as the core prices, obviously the business is really competitive. We've focused on price stability, and I think our results show that we've done a good job of that.
John, a pickup truck. This used to be, you know, you wanted an old GM pickup truck that you could drive around with your guitar next to you, and you know the whole.
Describing yourself as a kid.
You're down at Auburn University, and you get an old GM pickup truck that you paid $3,000, and you could see the road through the floor. GMC Sierra Denali Ultimate, ready? $91,900. That's what Paul's selling today.
So, Paul, are you telling us that you're expecting higher average selling prices in the second half?
Yeah, so John, we saw higher ATPs in the second quarter, about $1,600 higher than the first quarter sequentially. You know, I think we're going to continue to watch it. We've taken this whole year with a little bit of caution, just understanding the macro that's out there. And what we said at the beginning of the year was, if the customer held in and we were able to maintain pricing, we expected to significantly outperform the guidance that we posted. And then after the first quarter, we raised guidance by $500 million on the EBIT line, and now we're raising it by $1 billion. So we see a lot of stability in the market. We're just kind of taking it one day, 1 month at a time, and watching the results come in. We've got to be focused on quality, and we've got to be focused on getting production in the vehicles that customers want.
Let's just talk about customers a little bit more. We saw some data recently, I think, from the Federal Reserve in the last couple of weeks about people being rejected for auto loans. Paul, can you give us an idea of how some of these purchases are being financed and the kind of trends you're seeing develop?
So, you know, we've got a lot of good insight on that through our GM Financial captive company, and their results are pretty strong. We continue to write new loans. In fact, we've written at a higher share the first half of the year than traditionally, which is not a bad thing. We're there to meet our customers where they need us, and GM Financial has done a great job of that. We watch the credit metrics on a weekly basis across their entire portfolio, and we haven't seen anything that gives us reason for concern. We have really good high-quality borrowers on our new vehicles, and the credit is performing quite well from that. So we understand, obviously, in the subprime world and some of the used cars where we've seen banks tightening a little bit, that's not necessarily our forte, but certainly where we're lending on new vehicles, the results are pretty strong.
Paul, I'm going to pick on Itay Macaulay at Citigroup. In that, from the pandemic, from the end of 2019, I got a shareholder return of 3%, 4% per year. Whatever the number is, it's low single digit. Clearly, it's not acceptable. The fact is, somebody as knowledgeable as Itay Macaulay or the team over at Bloomberg Intelligence looks for huge share price performance from GM. What is going to be the catalyst for people to realize the new profitability of GM? What's the thing that's going to get me to Itay Macaulay's price target, which is a double?
Yeah, so that's the question of the day, Tom, and one that we spend a lot of time thinking about, obviously, for our shareholders. One of the things that we've got to do is we've just got to continue to consistently perform. I'm a big believer that the market can't ignore fundamentals too long. And when you look at the type of performance that we've been driving, I think we're establishing a really good track record of credibility. So that's job one. Number two, on the macro side, clearly it's been a bit of a headwind over the last 18 months as, expectations are consistently downward from where we are, which is why it's so important now that we've put 2 quarters out there with a raise on the guidance. This year will be really, really strong. We're overcoming pension headwinds. We're overcoming some normalization at GM Financial's earnings. But the results are going to be very similar, if not potentially better than last year. So that's what we're focused on. On the market, I think it'll come around. We've got to make sure that the macro clears up a little bit. I think we've seen that over the last couple of months. And, I think we've got to make sure that we reach an agreement with the UAW, not just for us, but as an industry, because obviously there's some uncertainty around that in investors' eyes. But we're focused on executing. We're focused on getting a deal that works for our people and rewards them for the tremendous work that they're doing across the board.
Paul, really unfair of us to save this question until the end because we only have a couple of minutes left, but I need to get this in. There are some subtle indicators worldwide that EV demand is tailing off. And I ask this question to you as a CFO. How do you manage the risk of a massive investment cycle and a huge push wholesale just going into EV not working out? And in 5 to 10 years, consumers don't want this stuff. We see greater efficiencies through hybrids, maybe even fantastic sustainable fuels. Paul, as a CFO of a car company right now, how do you manage that risk?
Well, John, I think it's a great question, but it's one that, when I look at the portfolio of vehicles that we have, really, really great internal combustion engine vehicles and a growing EV business off of a platform where we've designed EVs from the ground up. A lot of the EVs that are on the market are, traditional ICE vehicles where, companies have put a battery solution into it. And it's not optimized in that standpoint. When you look at the Ultium platform of vehicles where we're growing production very, very rapidly. Now, we think we've got vehicles that customers demand, and you certainly see that in our order books across the board. So one of the things that you haven't seen from us is the type of pricing volatility that many of our competitors are experiencing with some of those vehicles that were early to market. We think our vehicles, when you look at the Silverado EV, 40% more range than anything else that's out there across the board. We think we can win customers over the long term, but we've also got a very good ICE portfolio to fall back on, and it's driving incredible performance for us.
I said it was unfair. It was unfair because we need a much longer conversation about this in the future. Paul, appreciate your time, sir. The General Motors CFO. That stock this morning doing okay. From New York City this morning, good morning.
The real growth picture is pretty poor everywhere.
From an economic perspective, I think all of us expect a deceleration, a slower economy.
This is the environment where you have to be more nimble.
We're cautious and think that the conditions are there for a full-blown recession.
I think we're going to get a lot of clarity this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Abramowicz on assignment. She'll be here tomorrow for The Fed Decides. Look for our coverage 2 p.m.-ish tomorrow afternoon, 1:30-ish. Who's keeping score? I'll show up at whenever they say, and we'll do The Fed Decides tomorrow. Right now, we decide that markets are lifting in the heart of earnings season. We've had a real focus here, yes, on big tech, but John, there's more going on there, including what we just heard from Generous Motors.
Look, we came into the year and corporate America was worried about a slowdown. Investors on Wall Street were worried about a slowdown.
Paul Jacobson.
GM have just raised their outlook for the year. 3M, Tom, a company you follow closely as well in the last hour, they've raised their outlook as well. So that's a bunch of companies with exposure to different parts of the economy raising their outlook. We saw it from the airlines, didn't we, a few times in the last couple of weeks too.
And what's important here is I don't think we heard the phrase AI from Paul Jacobson, the CFO from GM. 3M is fighting for their life here, but they got a nice $2 pop here this morning. Raise outlook, top estimates. Cost cuts gain traction. Is that the view forward for the next 6 months? Do we see rationalizations, as they say?
So the question I would have, Tom, is if we do start to see a deceleration in growth, if we see further disinflation to complement the trend of the last month or so, the last couple of months, what does that mean for the earnings outlook? For top-line revenue growth specifically, how does that work? And can they cut costs quickly enough?
The moving parts, and part of this is what we'll see tomorrow with the Fed as well. We've really focused on the ECB. Let's focus on the Fed right now, John. It's a snooze fest. I don't think so. He's going to pick up the paper. For those of you on radio, I've got my paper here, and Mike McKee's going to, Gianna Smilik over at the Times, they're going to ask some rude question, and he picks up the paper and he goes, da-da-da-da-da-da-da-da. Somewhere in there is going to be some direction.
2 more inflation prints between this meeting and the next meeting in September, and a Jackson Hole meeting as well. You can lean on the forecasts. A Jackson Hole speech, of course. I'm aware there's no Fed meeting. Forgive me for the slip of words, TK. I think from there, Tom, you lean on the forecast in the summary of economic projections, which indicate 1 or 2 more hikes this year, and you wait for the data between now and the next meeting in September. You wait for the
data. This is true, and it's true of BOJ with inflation running away. It's true of ECB with all the challenges, including German and, might I say, French slowdown is, well, they're massively data dependent, out of a pandemic. Maybe we're getting back to traditional economics. I don't see it yet.
Jackson Hole Symposium, I think, is the correct terminology.
So if we went to
a symposium.
If we went to Sintra and Jackson Hole, took the entire team, the answer is we go to symposia.
Is that right?
I think
don't know.
so.
Your English is better than mine. Let's turn to the price action, Tom. Equity futures on the S&P positive by 0.1%. A little bit of a lift in this equity market. Yields a bit higher by a couple of basis points. Your 10-year 389.44 in the FX market. Just a weakness in the euro. Need to sit on it. Euro dollar 110.51. I know it's only one day today of about 0.1%, but it's 6 consecutive days of those kind of moves, and they add up. 6 consecutive days of euro weakness off the back of weaker European data, Tom. Bottom line, things aren't looking great on the continent.
These are trends in place, and they get ignored, like the Dow is up 11 whatever days in a row, and that's a broadening away from tech as well. I'm fascinated, John, by the double barrel of tech earnings out to August 3rd, which is Amazon and Apple.
Yep, next Thursday.
Double-barreled with, and granted it's smaller and less visible, luxury, which I believe starts today with Louis Vuitton. It's going to be interesting to see, the combo of high multiple tech, wicked high multiple luxury, and how they do.
After the close, LVMH.
Which close, though? Paris close? Washington close?
I believe the European close, I think. But maybe I'm wrong about that.
Should you and I go over to 57th and 5th Avenue and maybe they'll report earnings from there?
Knock the door at Tiffany's and ask?
Well, no, Louis Vuitton's across the street. We can go there.
You want to go there instead?
Yeah,
Okay.
Well, I don't know. I haven't been in an age.
Is it still a thing? I haven't gone at all.
I'm not sure if it's still a thing. But they do have the Tiffany thing going, and that's been a huge deal.
That's been a big hit. Quite a transformation.
I don't know. I think we're going to find out in the earnings call if it's a big hit as well. Right now, we're going to get to this, and we're going to get to it with a congenital optimist. Drew Mattis is Chief Market Strategist at MetLife Investment Management. He has been wonderful about gaming the optimism of the American economic experiment. Drew, let's start with that. Glass half full, glass half empty at MetLife.
Well, the good news is there's not going to be a recession this year. The bad news is it's still coming. We've had to move back our forecast from mid-year to the start of next year. The reason we went that far, actually, is because we think consumers are still in this ball game. They're still in this you only live once mentality post-COVID. But we do think when you get to the start of next year, you'll have a lot of more headwinds. And some of the data now that's currently pointing towards a recession will probably be even worse. And we think the turn of the year is about the right time.
The raging economic debate, and maybe this will be alluded to in the academics of Jackson Hole, is whither R starred, whither the rate post-pandemic we're gliding to. MetLife is riveted to the actuarial return expected within longer-term portfolios. Have you adjusted that view? Have you lowered your expectations for return, or can you be more optimistic about a better return post-pandemic?
So I'll say this: when we think about, so let's get past the next recession, whenever that is, right? We think it's next year, but let's just say in the future. When you come out of that recession, what are you going to have? We're very optimistic there, and that means higher potential growth rates. We think that there's the potential for participation rate rebound, even beyond what we're seeing, higher productivity, although it's hard to get lower than we currently are, but we expect a rebound in productivity that's sustainable and will be sizable. And we expect, therefore, that potential growth will be higher. And with potential growth being higher, we expect neutral interest rates to also be higher at that point.
Drew, build that out a little bit more. What's going to drive higher that productivity, potential growth, higher neutral interest rates? Where does all that come from?
I think, so first of all, from kind of a worker perspective, I think you're going to have people engaging in the workforce for over longer periods of their lives, and during healthier periods of their lives. I think the healthy period of people's lives are going to expand. And I think that that's a consequence of some of the gains we've made in biotech during the COVID problem. So I think so that's first and foremost. Secondly, work from home will encourage older workers to potentially stay in the workforce for a little bit longer. And I think firms are going to respond to that by making it easier for older workers to stay in the workforce for longer. And so not only are we going to potentially have this rebound that we're seeing in kind of the so-called prime working age group, but we're also going to see other groups actually engaging more aggressively in the workforce. And that'll be good for the U.S. economy as a whole. Productivity-wise, I'm doing this from my office via Zoom, right? I mean, in the past, this would have been very difficult for us to pull off. And it's just a much more convenient and productivity-enhancing arrangement. And I think if you go through and look at whether it's the cost of putting objects in space, which has deteriorated significantly or lowered significantly, when you look at gains in kind of biotech, for 25 years, we were promised miracles in biotech, and we finally saw some, and no one's paying attention, right? Because we were distracted by the fact that, it was a crisis situation. But, those things all add up, and they'll all begin to interact with each other in ways that, I can't probably fathom completely how they'll all interact, but they'll be productivity enhancing. And I think we're in for a big productivity ride once we get through this next downturn.
How rate sensitive do you think the economy will be that you describe?
I think initially every economy is rate sensitive because you have to finance all of this stuff. But I think, in some ways, the die is cast in some of these industries. You're seeing the deteriorate or the lowering of price and cost of getting things into orbit. That's already happened. And so, I think for now, it's just a matter of how do we exploit it best. And, whether or not, my forecast is going to hinge on kind of, am I right or am I wrong, which I know sounds obvious. But I do think that, the history has shown you should be optimistic for developments in technology, not pessimistic.
So then what does that give your GDP statistic out 1 year? I'm not talking about quarter to quarter or that. On a longer, broader term, you're in a meeting at MetLife where people's idea of short term is 10 years. What's your GDP run rate? Can you get above 2% real GDP?
If I had to put potential growth 10 years from now, I'd probably put it closer to 3 than 2.5.
Wow. 3 real percent real GDP.
I think that is a reasonable estimation.
Wow, John, that is a wow statistic from Drew Mattis. I can't convey how off norm that is. And that goes to the responsibilities of an insurance company where they're really focused every day on a long-term view.
So, Drew, can we finish on this just quickly? If we get a rate hiking cycle ending with a hike this week, let's just say that. Maybe you get another one, but who knows? Drew, when they start cutting, have you got firm ideas on what they cut back to? Because clearly there's a consensus out there that we don't go back to zero. What's your view on that currently?
I think there'll be a 3 handle at the low point for the next cycle.
Okay. And you think the bond market is well priced for that, given the way you see the yield curve evolving in the last few months?
I'm actually a little surprised at where the yield curve is, given this expectation that we're in a, we're going to have a soft landing, to be honest. I think, when you think about what a soft landing means, it means that the Fed probably wouldn't have to reverse course. So they're going to be stuck at kind of this 5% plus for a Fed funds rate. And so where should the rest of the yield curve be in that kind of scenario? And what should that yield curve be shaped like? And when I look at the current shape of the yield curve, I don't see that reflecting that belief.
2-year, 10-year, just around 100 basis points still. Negative 97, 98 this morning. Drew Mattis, thank you, of MetLife Investment Management. Some big calls there, Tom.
Big
about
calls,
the
John.
future of this economy.
I'm going to say in Q3 right now, you just saw the headline of the quarter, right or wrong, what Drew Mattis says there about a run rate of 3%. I'm going to hedge it, near 3% real GDP, John. That's an extraordinary statement by Drew Mattis with all of his heritage. In the future, long term, that's a run rate far beyond potential GDP as analyzed by a lot of smart people.
If you're just joining this morning, welcome to the programme. Live from New York, your equity market positive by 0.1% on the S&P 500. Yields are higher by a couple of basis points on a 10-year, 389.24. The euro is weaker. We've talked tons about the weakness in the economic data in the Eurozone. Haven't talked a lot about Japan, Tom. So Japan with the BOJ decision on Friday, and we'll see what the outlook there looks like for inflation. So you've got all these little nuances starting to come to the surface. The difference between the Fed and the ECB, Wednesday, Thursday. Then the difference between the ECB and the BOJ, Thursday, Friday.
And I'd go all Damien on you and bring in EM as well, how EM bounces off the central banker to the world, Jerome Powell, and on the Pacific Rim, how they bounce off Japan in their unique experiment, to say the least. Foreign exchange is a litmus paper here. I've got stronger yen over the last number of days, 143-ish down to 141. But the answer is it's one big mystery, and I would go back with the slowness in Europe to the worry of the Japanification of Europe. I don't hear that in the zeitgeist right now. You keep this up for a number of months, you may get that.
You may get some real weakness. Germany in recession. And based on the recent economic data, they're not coming out of it.
The most important chart to me, John, is like nominal GDP of Italy is flatlined for a decade. Or, I'm making this up as I go, folks. Stay with me. But the bottom line is the animal spirit of selected economies out there, including Japan. I mean, what's the why? Why is Japan doing YCC? They're trying to impute inflation into the system to reflate and jumpstart lousy nominal GDP.
A once-in-a-generation opportunity to do so. Tom, the other point in Europe as well, the weather getting so hot in parts of Europe. There's a real fear about maybe losing some of the tourist season on the continent.
There's no joke. This is really serious, and it creeps north off the Sahara, off the Mediterranean.
Equity futures on the S&P just about positive. Stephanie Roth of JP Morgan Private Bank coming up very shortly. She's joining us in about 20 minutes' time.
Hopefully what they'll do is acknowledge that there has been some softening in the path of inflation, because that is factually correct. But at the same time, it's too early to call victory on the inflation fighting battle. And after that, what I think they should do is just leave all doors open so they can go again in November, or this can be the end.
That's a decent description there from Gargi Chaudhry of BlackRock on what most people expect from Chairman Powell and the Federal Reserve going into tomorrow's decision. Coming into today, the two-day meeting commences down in Washington, D.C. for Chairman Powell and company on the FOMC. Your equity market going into it shaping up as follows on the S&P 500. Equities are higher by 0.1%. The earnings this morning so far so good. GM raising the outlook. That stock just about unchanged in the pre-market. 3M raising their outlook as well. That stock positive, Tom, by 2.7%. in early trading.
Thank you so much for bringing us up. Full disclosure, my mother grew up in Minneapolis, and we've had a heritage, a bias to Minnesota manufacturing and mining for years. John, on the ANR screen, which is the sell-side research analyst screen in the Bloomberg, 3M, such optimism. 16 holds, 4 sells. John, I've never seen this. A so-called blue chip company, this one deeply troubled. There are no buys. 0. There are 0 buys on 3M on the Bloomberg screen. I find that absolutely
I was totally
remarkable.
unaware of that.
Yeah.
That's amazing.
But that shows you the nuances here away from our silly fixation on Microsoft and Google, which you and I will be guilty of at 4:15 this afternoon. But that's what we're trying to do here, folks. Give you earnings season, earnings.
How many of those holds do you think are actually sales and are just maintaining a relationship
Oh,
with
don't get me
management?
going on this. And the current's going to be angry. Don't get me going. A hold is a sell. I am in the camp.
I've always felt the same way. What does it even
I
mean?
have been in the room where the general counsel or the youngin to the general counsel says, we can't say sell, we got to say hold. A hold's a sell. That's where I am.
Or an equal weight.
Yeah,
Equal
and
weight.
David
Neutral.
Balin at Citigroup
We're
would
neutral.
say I'm nuts or whatever, but there it is. I'm going to go to this. We're going to get to this quickly here, and then Enda Curran is going to join us here for a timely call. I can't say enough, John, about what we just heard from Drew Mattis. We begin the third quarter with the headline of the quarter. I'm sure there'll be other ones along the way, but the idea of the optimism there of, as you mentioned correctly, John, productivity lift, technology success of America to 3% inflation-adjusted GDP. That's a lonely call of optimism.
And the Federal Reserve, if they do cut, Tom, he believes they only cut back to, say, 3. And we have to get used to a world of 3% and above, which is the old world, right? You know, the last 15 years have been an aberration.
The surveillance talking point out to Jackson Hole. Right now in China, and we will do what we do best, is rip up the script with an expert. Enda Curran is global economy correspondent in Washington for Bloomberg News, but encyclopedic on his pandemic tour of duty in Hong Kong. We're thrilled he could join us this morning. Enda, do you link in foreign minister upset in Beijing to the economics to finance the investment challenges of Beijing?
It's an open question, Tom. I don't think anyone has any real insight. As you mentioned, the replacement of Qin Gang as foreign minister, that does end a month of speculation. We had a very extraordinary situation whereby China's foreign minister disappeared from the world stage. He was replaced by Wang Yi, and that seems like that's what's going to continue from here on. We don't know how long Wang Yi will remain in that job, or if they'll name somebody else as foreign minister at some point in the future. But certainly we had that snap meeting last night of the Politburo. They've decided that the foreign minister is out. He's out, and we don't yet know why, Tom.
And John and I have such respect for you. I'm going to float this question. It's grossly unfair. Anne-Marie Horton brought up beautifully the backdrop here. It mentioned in some way extramarital affairs or whatever. Do you think those kind of personal or social matters folded into this debate, or was this more discreet and about professional foreign diplomacy?
Well, personal conduct can certainly be cited against officials. We've seen that in past corruption cases when the readout has come after their conviction. Personal conduct has featured in that. We don't know if that's the issue in this particular case, Tom. Certainly it's been central to the speculation. We all know that. It's been widely reported and on social media. But there are observers who say, typically speaking, that might not be enough to knock off someone of such seniority. And remember, Qin Gang rose up through the ranks very quickly. He was seen as being quite close to President Xi Jinping, so there's double surprise that somebody like that would fall from grace so quickly.
And let's just build out what we did hear from the Politburo on the economic side yesterday. I saw a series of headlines about doing this, that, supporting consumption domestically, saying all the right things. Can you get your hands around any firm policy measures that have been announced in the last 24 hours that can have a material effect on growth?
It's a little light on details, John. I think people are seizing on the idea that they dropped a statement that houses are for living in, not for speculating. That's the first time since 2019. So the thinking there is maybe they're easing up on the crackdown on the housing sector, which they already have been, and they will allow perhaps developers and others to get on with building more houses there, and that will obviously partly at least reflate the real estate sector. So some people seizing on that phrase, perhaps some better news for the real estate side of things. On the consumer side, a lot of focus on boosting confidence, but as you say, short of specific hard measures, there was talk of selling more bonds or expectations of selling more bonds at local government level to build infrastructure. But there's also commentary in the Politburo readout about needing to control debt, local government debt. So expectations there for maybe restructuring and debt swaps. So I think mixed signals, but the big takeaway seems to be it's on the dovish side. Whatever they're planning will probably be enough to maybe get the economy to hit that 5% official growth target, but certainly nothing like the stimulus of the go-go years. And it would be wrong, I think, to expect we were talking about a stimulus like post-08 or maybe around 2015, for example.
Pushing on a string is a phrase we heard a lot in the last couple of decades in several situations. And a balance sheet recession would be something new and widely anticipated by many people for a long, long time. And did you see any evidence whatsoever that a balance sheet recession is occurring in China?
Well, it's certainly become the talking point of the moment. I mean, there's no doubt that there are some similarities with what went on with Japan, John. But you have to say there's still a lot of potential. One of the key defences for China's economy is that it has not yet hit its economic potential. Look at the potential for the middle-class consumer, the urbanisation story, that hasn't gone away. So that's what a lot of the defenders are clinging to in terms of where China's economy goes from here. But structurally, though, the demographic story is certainly leaning against it. The debt story is leaning against it. And you'd have to say that, at the very least, the government has a big job on its hand now to try and turn things around in the coming months.
Big job. Enda, thank you, sir. I know we're going to catch up a little bit later. Looking forward to it. Enda Curran there of Bloomberg on the latest down in Washington, D.C. Spent a lot of time in Hong Kong. A deep understanding of the economy there and the Chinese economy as well. It's going to be a key focus for us in about 25 minutes' time. We need to talk about the difference right now between what's emerging in China as they push a stimulus effort, in Europe as they try and contain the fallout from a recession in Germany, and in the United States with all the hopes and dreams of a soft landing engineered by this Federal Reserve. We're going to do some of that with Mike Collins of PGIM. We'll speak to Tiffany Wilding of PIMCO, Mark Mahaney of Evercore on the earnings from Big Tech a little bit later, and Christian Mamani of Lafayette College. Stellar lineup, Tom, going into the opening bout
important
in about 35
lineup,
minutes.
and really must listen for those of you going into technology earnings here. Mark Mahaney, I've known for ages, and he's just bulletproof on basic securities research 101. He's not someone bedazzled by AI. I just don't see that.
He's not counting how many times they use
he doesn't give it. He's seen it all before.
They use the phrase, the acronym a little bit later.
Back at Citigroup and, over the years, RBC now, and Evercore ISI. I mean, this guy's, like when Ed Hyman's standing at Evercore ISI going, what do I do with Apple? That's who he turns to, Mark Mahaney.
We'll turn to him
that simple.
A little bit later.
And Julian
to get his view
Emanuel
on that.
takes notes.
Do you think Julian takes notes?
Julian takes notes when Mahaney opens his mouth.
Okay.
What's great about Mahaney is he can take a Fender Precision bass, play it totally differently than a jazz bass.
He's a guitarist.
Yeah, bassist. Come on, there's a difference.
Nice. Isn't bass easier?
Yeah, bassists get the girls.
But bass is easier, right?
No, don't.
I thought
John,
bass
that's
guitarist.
a folks' pa. You're going to be Mahaney's going to cancel on you.
I thought bass is what you played if you weren't musically gifted, but you wanted to join a band. So you just played bass. No, if I got that wrong.
You got that so wrong.
I thought that was the case.
Mark, don't cancel. Mark, don't cancel, please.
Is that wrong, really?
Don't cancel.
Come on, be honest. I thought that was the case.
No,
I feel like you're lying to me. Futures on the S&P, just about positive. Good morning.
Bloomberg Surveillance, we say good morning to you. A really eventful day. We're going to go into an important day. Later this morning, out of Paris, you're going to begin to see luxury in France. And it has been a boom stock environment for Louis Vuitton, Hermes, and the rest of them. And we'll see what they do forward here. And then we go on to tech earnings this afternoon. Look to Romain Bostic and all that we're doing on Bloomberg Television and Radio this afternoon in the tech earnings. Before that, we're going to get a 30-minute pre-brief here on the economics of the day and the housing data. Case Schiller, I'm more interested in 30 minutes. But right now, a statistic, Philadelphia Fed non-manufacturing to provide brilliance. Michael McKee.
You can't add a lot of brilliance to the Philadelphia Fed non-manufacturing index.
Is that a service sector index?
It's service sectors. It is not nearly as old as the manufacturing index. And, of course, the regional indexes don't make as much of a difference.
Right.
But 1.4 is the number. It was negative 16.6 before. This kind of flies in the face of the other service industry numbers we got this week, the S&P Global PMIs, because those went down a little bit. But there's so much going on in the economy right now, Tom. I can't imagine that this adds anything to the Fed's knowledge.
Was this number adjusted because Bryce Harper played first base for the Phillies the other night? Shocking to see.
Probably
had something to do with it.
Yeah. Well,
Tell me about,
when he tumbled, that was a... Yeah.
You and I would go to conferences, and the joy of Carl Case of Wellesley, the late and hugely missed Carl Case of Wellesley at college, Mr. Schiller holding court at Yale. We got Case Schiller coming out here at 9 o'clock. I'm sort of thunderstruck by a negative statistic on one of the series, flat on the other series. Do you presume that we will get negative 12-month trailing statistics on housing?
I haven't done the math on that, but we could get there. It's a difficult issue because they do a 20-city survey and they do a national survey, which is extrapolated out from that. And so individual housing markets are different, as we've seen over the years. So it's hard to know where we end up.
Right.
The thing that has surprised everybody was the lack of demand because there are no houses for sale. And so lack of supply means your price tends to go up. In this case, they're starting to come down or at least flatten out. And that is probably more what the Fed is looking for when it's pushing up interest rates.
Let's get out to the Fed decides tomorrow. It's tacky for me to say what question and he asked Jerome Powell and all that. What does he not want to talk about? What's the thing he wants to avoid in the press conference tomorrow?
Well, he always wants to avoid the R word. They will never say recession.
Mm-hmm.
The minutes have shown that the last couple of meetings, the staff has forecast recession. And when asked about it, he sort of sweeps it aside and says, I don't want to talk about staff forecasts because he doesn't want to be on record as saying anything to do with recession. So watch that. And then he obviously does not want to say anything about what they're going to do or whether the committee is divided over what they're going to do at the next meeting.
One thing I wanted to bring up here, and it's going to be a constant theme for me. I'm going to wear you out on this, Michael McKee, and we'll talk to Stephanie Roth about this in a moment. Drew Mattis at MetLife with his optimism, the inherent Mattis optimism learned with Maury Harris years ago at UBS, hit me over the head with a 3% real GDP outlook long term. That MetLife short term is 5 years view, a huge optimism. Do we need a massive boost in productivity to get to the Mattis optimism?
We could need that because at this point, we're not sure where the labor supply is going.
Yeah.
It's been growing, and we're seeing more immigration. Does the labor supply continue to grow to help boost potential growth? If not, you're going to need something on the productivity side. Now, as I said a week ago, I was out in Wyoming at this conference with a bunch of CEOs who were all saying it's still hard to find workers and it's hard to find qualified workers, so we're putting more into automation. And at some point, you would think that shows up in the productivity statistics, but it really hasn't yet.
McKee out in Wyoming for this conference, in Idaho for that conference. What a life. She's jealous. Stephanie Roth joins us, senior market economist at J.P. Morgan Private Bank. I got to rip up the script here, Stephanie, and you can do this with a great combine team at J.P. Morgan. There's potential GDP, which is a pretty moldy number based on demographics and all the rest, the toxic brew, as Lisa would call it, of our economy. And then there are growth optimists out there. I think of Neil Dudd at Renaissance and obviously Drew Mattis at MetLife as well. Can you be a growth optimist?
I think it's hard to be that optimistic on growth. The number like 3% sounds quite optimistic to me. That said, the data that we've seen on the labor supply front has me a bit more optimistic than we've been. I mean, the immigration trends that we've seen have been really quite positive. We've added the combination of that plus female labor force participation picking up has added about 1.5 million people above what we had expected this year.
I look at your background of Bucknell, prodigious math, and your statistics work at Columbia. You bring a whole different template to economics as well. Do you have confidence in our data right now? Do you have confidence in your probability distributions looking out 1 year, 2 years, 5 years? Do you have a statistical construct that you can believe in?
I have to say, honestly, no. This has been one of the periods where it's been hard to have confidence in the data. You've had incredible revisions. You've had seasonal adjustments that have been very, very difficult to adjust since the COVID pandemic, and that's resulted in massive data revisions and incredible uncertainty. So between the uncertainty, the data having a lot of issues and significant revisions, and then on top of that, your models don't really work following COVID, I would have to say you have to be quite cautious about your outlook.
I'll throw one more thing in there that we haven't really started talking about yet, and that is the impact of labor strikes on the employment numbers, because we won't get an accurate count of the artists and writers and actors, because the actors didn't go on strike until after the reference week, and then we don't know what's going to happen with UPS. So we could have really messed up labor numbers. So it makes it harder for the Fed, which is my long way of asking a question. If the models don't work and you don't have a lot of confidence, how do you know that we might go into recession, and how would you put together a rationale for a vote one way or the other if you were on the Fed?
Everyone has been using history as a guide. So generally speaking, when the Fed hikes rates 500 basis points, you see something breaks. And I think that's what's gotten a lot of economists off sides in this cycle. Is history would tell you we should be in recession right now, but clearly the data have been conflicting with that. And we, over the course of this year, we've had to become a little bit more optimistic, just because the data have come in more resilient. You're seeing housing start to stabilize. So our base case is you still get a slowdown, but much more mild than what we had thought a couple of months ago.
When do you think that shows up? This quarter?
I think you get a continual slowdown throughout the course of this year, and then in the first half of next year is really when you start to see more sluggish growth, somewhere around 0%.
I look at how you dovetail your economics into, like, what do you do with investment right now? Do you have an outlook on the broader American economy that gives you as an economist an outlook on equity markets?
I think what we can feel good about is, the markets have rallied this year, but for good reason. Inflation has come down way more than anyone had anticipated. We're now looking at inflation that's trending around 3%. Which is not the 4 to 5% that we thought we were a couple of months ago. So that tells you, maybe markets have certainly rallied, but there are parts within the markets that look attractive. So for us, that's mid-cap equities or European equities, where you have valuation support in an environment where the fundamentals are still okay, and we're just avoiding some of the names that are particularly overvalued.
Okay, but this is critical then. And I don't mean you personally, I don't want to get you in trouble with your compliance, but at JP Morgan Private Bank, if you were lucky and own these tech stocks, do you maintain ownership of them? I'm not talking buy, hold, sell. I'm talking more as a cosmic event. I own this stuff. Do I sell it and go to the value proposition, or do I keep it but new money deployed to the value proposition?
Yeah, we're a lot of our clients are very overweight tech stocks, so we're very comfortable there. But we would add new money to some of the other areas, where like mid caps or an equal weighted S&P index.
What are you doing telling people about investing overseas, or we don't want to say overseas because you could invest in Canada, be foreign, but with the UK in deep economic trouble, with the Eurozone behind the U.S. in terms of growth and unemployment, is it worth it to venture outside the borders at this point?
When we look at our proprietary data of our clients, they tend to be very, very overweight U.S. So for incremental dollars, we are suggesting that they add a little bit of money overseas, and one of our favorite places would be Europe there. You are starting to see inflation come down a little bit. Valuations are supportive, and earnings growth should be pretty good. So that's kind of our favorite area. And then we do talk about Chinese equities, but a lot of our clients are a little bit hesitant to add money there.
I want to get back to your core abilities, which is statistics, the analysis of all this data as well. Speak to our viewers and listeners about how you interpret the data veracity of American labor data, BLS, Census Bureau, and the rest of it. Is it good data?
Yeah, I mean, I think the data is good. We have to take the data that are given because that's
Well,
what
I
we
know
have
that.
to
You say
analyze.
that about China as well, and look where that got us. But in America, do you trust the data?
I trust the data. I think we just have to be cautious that they're heavily revised. Pay attention to the seasonals, and then look at a broad skew of data. Don't just follow one indicator. And generally speaking, it's telling us that the labor demand has softened some. Labor growth has slowed. Wage growth, we'll see what happens on Friday with the ECI, but there's good reason to believe that we should see a bit of a softer print here, especially since the core services CPI, to the extent we can glean something from that, and that's labor sensitive, that has cooled quite a bit.
With the immense sway of James Dimon, can you talk to Mr. Dimon about getting the lockdown back in place in Washington so McKee can go down and sit in that little unair-conditioned room and get like the old days where like we actually get the data?
Data in advance.
I mean, you miss that, right? Instead of this delay at 8:30 that we get now.
Oh, absolutely. We would much prefer that.
Right. Stephanie Roth, thank you so much. She's with J.P. Morgan Private Bank, just really bringing a really twisted interpretation of our economics to us with statistics as well. On the data front, I really want to go through this because I think it's absolutely fascinating in earnings, and I want to make clear that in terms of the visible earnings that are out there, it really begins, I'm gaming here, 3 hours is my guess. Don't help me with the summer time zones and that. But we're going to get a Paris shutdown, and you're going to first see LVMH come out with earnings, I believe, at about 11:30 our time, maybe 10:30. But later this morning, let's go with that to be safe, you're going to see a first big earnings from a dominant provider in one of the go-go stocks of the moment. The two-year yield, 4.87%. SPX elevated up just 0.1%. We welcome all of you here on a Fed Day. Michael McKee with me as he travels down. When do you go down? I mean you're not going to do this by Zoom, are you? I mean, you're going to go down there.
Those days are over now. Yeah, I'll be going down this afternoon.
Well, how do they pick the questioning of it? Do you know in advance when you're going to get called?
No.
Is there a rhyme or reason to it?
The chief of staff of the Fed is the one that calls on you, and basically their model is to call on the major print publications first, and then they call on the TV people.
Why do they do that? I mean, that's
a good question.
Grossly unfair.
We should send you down there to, make them listen.
It's just, but that's really how they do it. They call on print first, just out of a tradition.
Yes.
When he reads a statement off, do you make note of he's reading a prepared statement? Is that important that the answer is so important that he has to read a prepared statement, or is it not a big deal?
Well, it's a big enough deal. You want to know what the rationale was, but a lot of it is word for word what's in the statement. You're listening for anything that is additional or on top of that, and you're listening while you're looking at your list of questions because you want to make sure he doesn't answer a question in his opening statement.
I mean, it's fascinating to me how there's a question. How many times has it happened to you where you've got 5 questions lined up and Smilik of the New York Times asks one and Leisman asks one and then Leisman does a follow-up and then the Washington Post asks one?
That happens all the time, which is why you go in with more than 5 questions. And then, of course, when they put out their surveys or their statement, there's always questions that arise from that as well.
I will state, folks, that under pressure, this is not easy. The first time I saw this was with the great Simon Kennedy and John Snow, and let me tell you, those press conferences are power-packed. We'll have our coverage for you tomorrow. The Fed decides, and look for that. Please stay with us. Futures red and green on the screen, I should say. This is Bloomberg.
And I'm critical of Powell because, as you may know, they use a portion of the data they use is quite lagging. And they didn't see inflation when it was here. And then when they showed up late and big. They went straight vertical on rates. We had to increase rates. We should have done them much earlier. He shouldn't have had negative interest rates. He shouldn't have been buying mortgages into May of 22. That should have stopped so much earlier. We didn't need him to do that. But when he finally stopped, he went the other direction, and he went so far, so fast. And I'm saying, just wait.
Always timely, but now never more so with what we see in commercial real estate. Mr. Sternlicht, Barry Sternlicht, Starwood Capital Chairman and Chief Executive Officer. This is a conversation, Bloomberg Wealth with David Rubenstein. The interview is tonight, Bloomberg Wealth at 9 p.m., and I can't say enough about looking for this on Bloomberg Digital and on YouTube. We're building out our YouTube abilities. A lot of people going to YouTube, and look for that. Barry Sternlicht with David Rubenstein. Now joining us, the David Rubenstein as well with the Carlyle Group, and of course his work for Bloomberg Wealth as well. What a timely conversation, David. What did Barry Sternlicht say about the commercial real estate debacle to come?
Well, he thinks it's going to be a hurricane, kind of a Category 5 hurricane. What you have is a combination of people not going back to work physically, and people really, because of higher interest rates, not valuing buildings as much as they used to. So the result is you have an enormous amount of commercial office space in this country that's worth a fraction of what it was supposed to be worth. And at some point over the next couple of years or so, Barry Sternlicht would say, and others would say as well, this real estate is going to have to go into default in some way or another. The banks are not going to be able to really justify the debt that they have on the buildings, and the landlords aren't going to be able to pay the debt. So you're going to see a very large effort to, I'd say, sell a lot of this debt at discounts, right, and it's going to cause some problems in the banking community and the real estate community.
There's a suppleness to Barry Sternlicht's career, folks. If you're just joining us, this is the conversation of the day. I'd like to say to Mr. Rubenstein that we'll extend this discussion for 1 hour, but John Farrell would be upset by that at 9:00. David Rubenstein, this is so important. Who is Barry Sternlicht, and why do people like you lean forward?
Barry Sternlicht is one of the major forces in the U.S. Real estate market. He built a very large company in the commercial office building and commercial real estate world, but he also built a large hotel company. He ultimately sold that to Marriott. But Starwood Hospitality was for a long time one of the largest hotel companies in the United States, consisted of major brands like Westin and Sheraton, among others. He also invented the W brand, which is now owned in effect by Marriott. But even when he sold all that to Marriott, he kept his real estate company, which is now one of the largest in the United States, and it owns enormous amounts of properties across the spectrum of real estate properties. And he would say a lot of it is struggling. He has turned some buildings back to the lenders, as most real estate developers and owners of real estate are beginning to do, unfortunately. And so he made his name, I would say, initially in the late 1980s buying distressed real estate from the RTC. And I suspect he thinks there's going to be a lot of distressed real estate in the next couple of years as well. Hopefully, he hopes it's not going to be his real estate.
Well, okay, but distressed real estate, David Rubenstein, clearly means the Japanese show up. We're beginning to see that. Cranes, C.J. Hughes over at Cranes, writing out new Japanese interest in the island of Manhattan as well. Will history repeat itself in our commercial real estate debacle where the foreigners show up?
Well, usually what happens is foreigners show up before the debacle occurs, not after the debacle occurs. Right now, I think you're seeing a slow diminution in values in office buildings. Anybody who's watching this show knows that when you go to a major office building in New York or other major cities these days, you don't see a lot of people there. And therefore, eventually, the people using that real estate are going to say, I don't need as much space as I used to because people are working from home 3 days a week or 2 days a week, and therefore I'm going to shrink in my next lease the amount of space I have, and therefore you're going to see enormous shrinkage in I think, the usage of office buildings, and as a result, the values of the leases are going to go down, and as a result, the building's property value is going to go down as well. In some cases, the banks are going to be forced to take over the building because the landlord can't afford to service the debt any longer. This is going to take place over another 2 or 3 years or so.
Is Barry Sternlicht an optimist on, I guess, the durability of work from home and the migration of commercial real estate office to individual residences? Does he think we can pull that off?
I think he thinks we're not likely overnight to be able to go right back to the 5 days a week and using all the space we used to. And so I think he's quite cognizant of the fact that the world has changed. In the United States, Outside the United States, he would say people are going back to offices, and it's not quite the phenomenon we have in the United States for a number of reasons. In the United States, you don't see people going back to the office 5 days a week, with very few exceptions. But he's a very talented real estate investor.
Right.
I've known him for quite some time, and he also moved his entire operations from the Northeast to Miami, ahead of everybody else moving to Miami. So he was ahead of the curve there, as he is in many other areas. And I think he's operating quite effectively down there. His company now has over $100 billion of real estate properties. And while he has given some of them back to the lenders, on the whole, I think he's in pretty good shape.
Barry Sternlicht on the hotel business. Of course, Starwood is iconic there within hotels. What did he say about the future of hotels? All I know, David, is every time I call a hotel, the price is dramatically higher than it was 12 months ago or 24 months ago.
Well, because they know you're going to stay there, they probably are jacking up the rate.
Thank you.
Because they're sure you can afford it. But I would say that the hotel business is coming back from the depths of the COVID period of time when essentially nobody was using hotels, and the stock prices of hotel companies were way down. Now hotels are coming back because we're seeing in the United States enormous amount of spending on discretionary travel, on discretionary going away from home kinds of things, restaurants, amusement parks, hotels, and so that the spending is up quite nicely in that area, and hotels are coming back. He's not so much in the hotel business as he was, but he's a leading light in terms of his thought processes, and he's really helped create a number of brands, not only W, but he also created the Baccarat Hotel brand as well.
David, in the time we've got left, I've got to bring up a bombshell interview earlier this morning. Drew T. Mattis was iconic at UBS with Maury Harris. He now holds court at MetLife. Drew Mattis, with exceptional optimism on the American economy, looked for long-term growth that would approach 3% real GDP. That's a hugely optimistic view out of American exceptionalism. Do you share that optimism that we underplay what our real GDP growth is and what it will mean to our financial system?
Well, that's a very high real GDP growth. An economy of our size, real GDP growth probably around 2% or 2.2, 2.3% is probably realistic in the current environment. I think 3% or greater real GDP growth when inflation is still reasonably high, I think is quite a high growth. Because if you have 3% inflation and you're saying 3% real growth, that's really 6% GDP growth the way it's measured. And I think that's probably not likely in an economy of our size. We did grow at 6% at one quarter after after COVID because we were so low. But right now, I think economies of our size, real GDP growth, 2% is probably realistic.
David, thank you so much. The most timely interview I've heard with Barry Sternlicht. You'll see it tonight on Bloomberg Television. Barry Sternlicht of Starwood with Mr. Rubenstein of the Carlyle Group. Bloomberg Wealth at 9 p.m. Tonight. And again, I really can't say enough about our digital distribution of this. We're really putting a lot of effort into what we're doing at Bloomberg.com and also out on at YouTube. We're blowing up our YouTube site to make it more accessible and more user-friendly. Accessible as well will be the Fed Decides. We're going to do this tomorrow. Lisa Abramowicz is rumored to be on the Gulf Stream right now. We believe we will get her in back. I'm not sure if Lisa will be back for the show tomorrow morning, but I'm told that her people say she'll be here for the Fed Decides. I will start that at 1:30. Maybe she'll slip in before the 2 o'clock start date. And, of course, we'll have the press conference of the chairman of the Fed with our Michael McKee in Washington as well. Red and green on the screen, just simply a churn waiting for those Microsoft and Google earnings. You'll see those this afternoon. Luxury out here in a couple hours. Stay with Alex Steele and all of. I don't. Alex is not here. I don't think. Alex is like off, someplace where I should be. She's off, doing something cool. Anyways, 10 to 12 noon today, you'll get some luxury earnings out of Paris as well. The VIX 13.98 shows some of the optimism on the market over the last 3 or 4 days. On Bloomberg Television, very important, Pierre-Olivier Gonache, chief economist at the International Monetary Fund in the 10 o'clock hour. Good morning.